Good morning to all. So let's begin this session. I would like to welcome all the participants and our today's dignitary. I would like to call upon CA NACHIAPPAN sir on stage. Please join us on stage, sir. So let's begin this session with our ICAI motto. So I would request you all to please stand up. Thank you.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामोषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते अस्मिन् लोकः अस्मिन् लोकः शतः सर्वे तदुना सवितश्चन कश्चन एतद्वैतं 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 एतद्वैतं
Okay, so before starting the session, I would like to take you through few more programs which we have planned for November and December. So those are as follows: is 1-day CP program we have planned on FEMA, then investor awareness program, CP program on AQMM, and then we have expanding horizon networking, merger and aggregation opportunity for CA firms, high T with high achievers. And there is one program which is being organized by WLBC committee. It's art program, Canvas of Joy, health awareness session, wellness first, foundation of resilience. And then 1-day CP program ensuring compliance and control, CP seminar on code of ethics, growing opportunity for IP, and then national conference on litigations direct and indirect taxes at Savera Hotel. So please do register us on our SIRC website. So let's begin this session. In the first session, we will be covering auditing accounting estimates, including fair value, accounting estimates and related disclosures, and going concern. So I would like to introduce our today's speaker for the first session. So CA NACHIAPPAN sir is a partner in Deloitte, Hensick and Sells. He is a chartered accountant with 20 years of experience in audit and assurance. He is largely aligned with the automotive sector and healthcare sector and has audited large listed companies and multinational companies. He is also a special invitee to the Audit and Assuring Standard Board. So let's welcome our today's speaker. I would like to call Rangapriya ma'am. Please present a memento to him.
Thank you.
Thank you so much, sir. So I would like to hand over the session to you. Thank you.
Good morning, everyone. Am I audible? Thank you. So first of all, apologies for dropping in late. My cab driver came late. This is the excuse I used to give in school, and I continue to give that. But yeah, that's at least this time that's the reality. Okay, school may not really be because I slept, but yeah. So I'd be covering two topics. One is on going concern and the other is audit of estimates. There is no particular order to it, but I thought, going concern is more interesting, and a lot of us also feel that it is a theoretical subject. But so then I thought it might be better to demystify that first. But let's try and make the session interactive with people who really want to know about it and learn about it. So I usually walk around a lot, and they did manage to give me a collar mic, so which means I can actually walk around. And I've always found in institute that the first 4-5 rows, the seats are always new. Okay, so they don't claim depreciation on that because it's never used. Okay, so but then this actually helps me. Okay, so wherever I use it, I'll be there. So doesn't matter really. So having said that, let's dwell into the topic. So when I started off, okay, so when I started my career as an audit executive, I started with Pricewaterhouse. Of course, I'm discounting the article period because I had no clue what I did. But after that, I started with Pricewaterhouse, and this was one area which we were never bothered about, right? Because it was always, what we knew as probably the people who do the work on the field was that, go vouch and come back, right? So that was our understanding of audit, okay? So something like a going concern or an estimate, okay? So those were all matters which the partners dealt with a client, okay? And what did they deal? I at least I didn't know at that point in time, and I'm not sure whether they knew as well, okay? But these things gets really interesting because these are all very subjective matters, right? So now the question, I mean, and the question of going concern has become more relevant now, okay, at least in the from the early 2000s, because of failure of multiple large companies for whatever reason. It might be because of fraud, or it might be because of economic non-viability or anything, okay. So then it becomes very important for us to understand what we are supposed to do as auditor with reference to going concern, so that we cover our risks at the same time, give a report, okay. As all of you know, NFRA has made it a little bit more difficult to resign from engagements which you are not comfortable with, right? Because now you'll have to report as to why you resigned, and there's an ADT4 that needs to be filed, and multiple regulatory compliance. So resigning out of an uncomfortable audit is not the norms anymore. Now, once you get effectively engaged, then you will have to close things out, right? And when we close things out, we have to close it out in a logical manner which covers our risks and and addresses public trust. So when we look at this, okay, the most important thing, okay, is with respect to any of the standards, okay, the entire standards of auditing is just code, at least according to me, okay, is just codification of common sense, okay. Ideally, if you were to apply our mind, then anyway you would have done most of the procedures which auditing standard basically prescribes you to do, okay. So then why is it there? It is there because everybody looks at it the same way, and the extent of judgments which can come in is basically standardized, okay. So that's the reason why you kind of have auditing standards, and unless there is something which says that something is right or something is wrong, then people will tend to do whatever they want to, right? So that's the reason why we have this, okay. So when you approach any audit, okay, unlike starting things with vouching, like how I initially thought it should be and how I effectively started doing things, it is important first to get an overall business understanding, right? What is the nature of the business the client or the company is into? What are the economic factors which are impacting the business, and what are the internal factors which are impacting the business, okay. So these things become very, very important for you to effectively evaluate things from a going concern perspective as well. So we start off basically by understanding the business of the client, and that's all part of our risk assessment procedure. This SA 315 effectively deals with risk assessment procedure. So going concern is not something which you evaluate at the end of the audit. It is something which you start with and you follow through with that throughout. Okay, that's how we effectively look at going concern, because if you wait for end of the audit for going concern, probably that it's already a gone concern. Okay, so the purpose of doing that audit itself might have been defeated. So therefore you will need to assess it right from the time of start of audit. So there are 3-4 typical concepts with respect to going concern. Okay, so one is, anybody, I mean, let's have a discussion. I think that's better. So what do you think are the key items with respect to going concern? Any idea? Any specific thing with respect to going concern which has really, okay, whether the company is doing real business? Okay, anything else? Something more technical from the standard? Negative net worth. Okay, solvency. Anything else? Okay, whether they're going to fulfill the financial commitments on time. Anything else? Okay, change in law. Yeah. Then business continuity in the foreseeable future. Sorry. Anything else? Okay, possible proceedings, CARP proceedings. Any proceedings against them. Then so is this a question or an answer? I am there to ask questions, but anyway, we'll address that later. But yeah, okay. I mean, loss-making company. Okay. So what did we all talk about right now? I mean, we spoke in terms of understandable examples, right? So what is this called from a accounting, I mean, from an auditing standards perspective? These are called the internal and external indicators of going concern risk, right? So typically when we think of going concern, we basically try and evaluate probably what is causing this problem. Okay, so these are the indicators. Okay, so we start with the indicators, right? So now you look at whether indicators exist or not. Okay, for example, let us say there is a company, a slightly different company. Let's say this company is manufacturing shrimp feeds, okay, or aqua feed, okay, or prawn feed, whatever. Okay, basically aqua feed. Okay, so in the current scenario and situation, okay, what do you think is the business of this company? Where do you think this business is heading? Is it doing good? Will it do bad? What are the indicators? Okay, US tariffs. So how will you evaluate now? Okay, that's how you compute your margin, gain or loss. Yeah, so now as an indicator, what will you do? So now you have a situation, right? You have a situation that there is US tariff, basically a geopolitical indicator that US is imposing about 50% tariff plus whatever earlier tariff existed with respect to import of shrimp. Okay, so now when you are doing the audit of the company, what is the first thing you will see with respect to that company? Yeah, order backlog. Yeah, what is your export mix, correct? So let's say US has put tariff, but I am supplying only to Australia. Is it going to impact me? No, right? So the logical thing is to see, what was the external or internal indicator we can see later. Let's say external indicator, how does it effectively impact us, right? So you effectively see whether it's going to have an impact on your export sales to US. If you're not going to sell to US, then it's not going to have any impact on it, right? So you need to get that business understanding to effectively know whether there's going to be any implications on your business or not, right? So you have now identified that there is a that there is a negative indicator, that there could be some risk with respect to the operations of the company. So what do you do next? Okay. Yeah, alternate markets. That's what you said. Anything else? Okay, discuss with the management on the next step. Anything else? Change in line of business. Okay. Then? Okay. So typically, sorry. So typically you evaluate whether what are the implications because of this and what are the mitigating factors, right? So when you now look at the mitigating factors, okay, so let's say you have this discussion with the management, right? So they will say that, let's say they are looking at alternate markets now, okay. So now what is your responsibility after that? They are saying we are looking at alternative markets. I'm going to export to, let's say, Australia, or let's say I'm going to export to Russia, okay. So now what's going to happen? What's the next step? What are we supposed to do? Hmm. Hmm. Okay. 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 Understood. Anything else? Any other thing which we will do with respect to this? Okay. Anything else? Hmm. 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 But you have to give your opinion this year, no? Let's say you're doing okay. So what will you do? Okay. Okay. No, no, okay. Let's take a so. Hmm. Hmm. Okay. Hmm. Okay. So. Hmm. Okay. So let's take an example. Let's say you're auditing for the year ended March 26. Okay. So and it's a listed company. Okay. So the financial statements needs to be signed, or at least a board meeting for adoption of the quarterly results should be held by 30th June, right? So now you have only 60 days post year end to complete the audit. Okay. In this situation, what will you do? You have to give an audit opinion. Mm. Mm. Mhm. So for you, 60 days time frame is enough to assess that. So will you, so end of the day, will we give an opinion or not on the financial statements? Mm. 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 No, facts we know, no. Trump has put tariff, we are not able to export. May affect. So we are saying we don't know. It could or could not, may or may not happen. So you're not giving an opinion, no then. Mm. 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 Can you repeat the last part? Okay. Let's say current ratio is negative. Today, it's, as 31st March, it's negative. Mm. 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 Okay. No, the company is okay. Mm. Mm. So you are saying you will not qualify going concern. Can we get to that answer? No, 30th June you have to sign off your financials. What do you do? Mm. 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 So what should we do? That's the question. Mm. Okay. Mm. 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 Okay. Mm. 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 Understood. We'll get to that. Yeah. Mm. Okay. Emphasis of matter. Then so you're saying maybe there is a problem we don't know. That's what you're trying to say. Yeah. Mm. Sorry. Mm. Mm. But that will happen after you sign off only. Mm. Even otherwise. Mm. Mm. Okay. So we will dwell upon that material uncertainty. But before that, okay, now let us say there are indicators, okay, that probably there is an impact on going concern, okay. The let's say there are certain significant indicators. Uh, let's say the like we said, let's say the current ratio is negative, okay. Effectively, the current assets, sorry, the current liabilities are more than the current assets, right? So we have a negative current ratio, and of course the company has made losses during the year, okay. So now what, and see, so this going concern as a concept is that the company will go on forever unless there is, you know, until it actually stops, right? So as auditors, we will not be able to look at forever, right? So therefore, there is a cutoff point as to until where you can effectively look at things, and until the point at which you can look at things for closure of current year audit at least. Okay, and again, let's step back. The assessment of going concern is management's work. Okay, it's their problem. The assessment of or the validation of management assessment is our work. So it might not always happen, but that's what the standard says, and that's what is required also. So now what effectively happens is that you have this going, you have identified these indicators of a possible impact on going concern. So then you will see or rather the management is effectively required to see whether it has sufficient balances, or let's say sufficient financial strength to at least withstand for the next 1 year or next 12-month period from the end of the reporting date. Okay. So let's say if it is 31st March 26, from a management's perspective, they have to first come up with an assessment as to whether the company will be able to sustain itself for the next 1 year, correct? So that's what is the requirement typically from a standard, and therefore what we do is we validate it. But however, if it is a listed company, it doesn't matter, you will finish by 30th June, okay? But let's say it is a private limited company where you might do the audit till 30th September, then just that 1 year from 31st March may not be sufficient. You will have to ask the management to prolong that assessment for a longer period of time, probably at least 1 year from the date of the audit report or the date on which the sign off is expected to happen. It can be off, maybe a month this side, that side, doesn't matter, but the period needs to be extended when you are testing this, right? So the important thing is to understand that you will look at the assumptions, etc., made by the management with respect to this going concern assertion for the next 1 year, okay, and you will basically challenge it and validate whether those assumptions are reasonable, okay. So now let us say the again let's just presume there's a sanction on Russia. So if you sell to Russia, you will not be able to repatriate the money back, right? So now if the management draws up a plan, okay, as an alternate to US market, they're going to sell it to Russia, right? Then that's not going to help you. Okay, these are small logical things, but it could get more complex based on what plan the management draws up. So therefore, you will have to effectively look and challenge the assumptions made by the management. It could be with respect to future profitability, based on future revenue growth. It could be based on new products that will be introduced and whatnot, right? So there could be multiple things. Okay, so we need to challenge it and then effectively see whether for the next 12 months, right, at least the company is in a good position to continue. Okay, so then if that situation did apply, then there were indicators of going concern, but there were also mitigating factors. So therefore, and if the management continues to prepare the financial statements on going concern basis, then you're perhaps okay to render a unqualified opinion. Okay, so this is number one. So now let's take this a little forward. Now let us say there are indicators, and you try and the management came up with an business plan, etc. Let's say for the next 1 year, next 2 years, next 5 years, whatnot, to effectively state that to effectively state that they will be able to stay afloat. And from your perspective, you have validated that, and you're not completely convinced. And let's say you're also not able to specifically state that they are wrong because the conditions are volatile. Like somebody said, Trump keeps changing his opinion every day, so we can't keep doing that, right? So in such a case, okay, you could look at something called the material uncertainty with respect to going concern. Okay, so again, this is an assertion which the management needs to make. They need to make disclosures in the financial statements regarding that, and then you would in your audit report also include a paragraph relating to material uncertainty surrounding going concern. Okay. So now in your assessment, let's say there is a doubt, or let's say you have assessed that there is a material uncertainty, but the management doesn't agree to that, right? Management says, no, we are very confident that we will stay afloat, okay, and they are rightfully in their sense. In such a case, if there is a disagreement on this matter between the management and the auditor, then effectively it might result usually in a qualified opinion, and based on the veracity it could go to an adverse opinion, but usually it results in a qualified opinion. Okay. So these are two effective situations. Okay. Now let's take another thing. Okay. So now you believe that the company is, let's say, all the evaluation, whatever we discussed about, everything has been performed, and management believes that they are a going concern, okay, and you don't believe they are, you don't even believe that there's a material uncertainty, you believe that they are not a going concern, right? So then what do we do? We'll give an adverse opinion. Okay. So if the management doesn't state what it is doing, then we will state what the management needs to do. Okay. We will state in the audit report, they will state in the financial statement. Just boils down to that. Okay. Now let's go to another situation where both of you effectively assess that there is a going concern issue. Management also acknowledges that there is a going concern issue, and you also acknowledge that there, and you have also agreed to that assessment. Okay. So now then what is the way out? What happens? Okay, give an unmodified opinion based on what is assessed in the notes. Then accounts has to be restated. You have not finished the accounts. Now how will it be restated? Okay. Got it. Okay. Okay. So that's the thing. So if it is assessed that the company is not a going concern, then the financial statements cannot be done on going concern basis. That is to say, on accrual basis. It becomes cash basis or realization basis. What do you expect to realize with respect to each assets and liabilities on that particular day. So therefore, in such a case, it effectively the financial statements itself is not prepared on going concern basis, and if it is not prepared, then it is fine, right? So you give you give an unmodified opinion, but however you will effectively bring in an emphasis of matter to bring to the highlights of the reader that the financial statements have not been have not been prepared on going concern basis, right? Sorry. Yeah. No, the thing is, manage whatever aspects which you effectively mentioned needs to be performed by the management, and you will validate whether what management has given is right or wrong. So it goes into that assessment. You see, now let's say you are running the company, right? You are effectively telling me that the company is not a going concern. Okay, then how will I, okay, as an auditor, be able to take an opposite position that the company is a going concern? Right. So that's very unlikely unless the management has some fraudulent intention to effectively show it as on a non-going concern basis, right? Otherwise, I don't think any of us would effectively even want to take that position, okay, that financial, I mean that a business which the management calls as non-going concern, the auditor goes and says that it is going concern, okay, unless there's a fraudulent intention. It could be for any reason. If that's a fraudulent intention is different. Okay. So now if the management acknowledges and still prepares financial statements on a going concern basis when it is not a going concern, then you will anyway give an adverse opinion. Okay, so these are the various permutation combination. Okay, the key thing, okay, is first understanding the business when you do your risk evaluation, etc., and see what will be the implications on the company and the business of the company. Then you will see what will be the implications for the next 1 year, whether the company will be able to sustain itself, and you will also ask the management to extend that period if felt required. And once you do that, you will evaluate the mitigating factors which has been effectively put in by the management to determine whether the company is a going concern or not. And based on that assessment and based on management's acknowledgement, you would effectively determine whether it is a clean opinion, a material uncertainty, or a qualified opinion, or an adverse opinion based on whatever we discussed. You will not. Provided you agree to that material uncertainty, then you will include a material uncertainty paragraph in your report, and management will also needs to disclose material uncertainty in the financial statements. Yeah, yeah, it's a material uncertainty paragraph, so there's no modification to that extent. Yeah. So effectively, okay, so there are 2-3 things, right? So yeah, so what happens? Let's say the company is has a negative net worth, it is loss making, okay. So what you would then effectively see is, again, from on the basis of what we discuss now, right? You will first see whether the company has adequate resources to carry out its operations for the next 1 year without hindrance. Now, let's say the company has a negative net worth but still has cash balances, right? So, and the cash balances are good enough to effectively carry on the business for the next 1 year. Based on the standard, you are only required to evaluate it for such period, unless you want to see more, okay, that's judgmental. But at least on a worst case basis, at least for 1 year from the date on which you at least sign off, right? So if you have that visibility that the company will effectively function, will continue for the next 1 year, and it has sufficient resources to meet the liabilities and other obligations as and when it arises, then you will effectively say that the company is, it is a going concern and you may not qualify the financial statements. The other thing is, let us say you are the auditor of a subsidiary company, okay, or let's say let's say you are the auditors of a company, okay, and this company, let's say, has some 2 or 3 large shareholders who are really interested in the operations of the company, okay. So then what might happen is those, so end of the day, what does it all boil down? Whether the company will be able to function for the next 1 year or not, okay, and for that whether there will be resources or not, right? So you will effectively, if the shareholders pledge in the sense, if they give an undertaking that if the company is not able to meet its obligations as and when it arises, if they are willing to infuse money and support the operations of the company, either as debt or as equity or as the case may be, and if they give that assertion, and if they have the financial strength to give that assertion, so effectively you have to go back and see the net worth of the person who is telling that I'll keep this company afloat, right? So if they have that financial strength, you will validate that as well, and then you could also take cognizance of that in basically concluding that the company, while it's still a loss-making company, the company might be at maybe a going concern. The other thing is, the company could also have unutilized, borrowing limits or facilities, and if those facilities will not be called back, let's say for the next 1 year, and those facilities are enough to meet the obligations of the company for the next 1 year. So that's again, so it's a assessment which you will do taking multiplicity of factors, and then you will conclude whether it is whether the company is a going concern or otherwise. Hmm. 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 No. So. Hmm. No, so that then it depends. So if you have identified buyers and there is a commitment, then you can look at it. Otherwise, the financial statements anyway, when it goes to that that IBC professional, whoever is doing it, unless there is it depends on what is the reason why it has gone to the IBC professional, right? So it is because of some mismanagement, etc., and they are going to course correct the company. Then during that period, if the volume of operations of the company can effectively substantiate that the company will continue, then you can effectively look at not qualifying the going concern or not preparing the financial statements on a going concern basis. But if there is a financial strain and therefore the company is not able to meet its obligations anyway, and you have actually looking at creditors to either take a cut, and you're effectively trying to dispose of the assets of the company to settle these liabilities, then the financial statements itself will not be prepared under going concern. So when they have not prepared the financial statements under going concern, then it is fine, you don't have to qualify. We'll say it is not prepared on going concern. So any other specific questions, or we'll move to the next topic? Mm. 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 Yeah, those disclosures need to come in. But to be fair, I have not dealt with such a case, so I don't know from practically how it happens. But but then based on prudence, I think there will be sufficient disclosures and probably an emphasis of matter as well, which says that this year the financial statements has been prepared and going concern. The comparatives, obviously, I have to do research to see whether the comparatives needs to be restated or otherwise. I'm not very sure. Last year's would be audited. As I told you, I can check and come back to you. I have not specifically done a research on it. Mm. 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 That's something which you need to effectively state, but I can check and come back to you whether there is a requirement to relook at the previous year numbers. But I wouldn't expect that to be there. But I'll look at it. No, but they have bought the business, no? So it will go into that other. No, from the time going concern has been established, the financial statements will be prepared on going concern basis. So there will be effectively, uh, effectively there might be some reversal. See, what would have effectively happened? Okay, all the assets and liabilities would have been restated to the value at which it will be realized. Okay, resolution plan. Okay, so now the question is whether you're able to, I mean, whether the settlement is happening based on the restated liability, okay, or whether you will go back and pay the old liability itself, okay. So that is an assessment that you need to do when that going concern thing is established. But under an IBC proceedings or anything, let's say the court says it's enough that you need to pay only, let's say 30% of the creditors, then you would have paid only the 30% of the creditors. Balance is all you wouldn't have paid, and in the previous year itself, based on that, you would have corrected those financial statements, right? So the question predominantly, see, by the time it actually revives, okay, the situation would have changed, and the values which are reflected would effectively be the values at which the operations would happen in the future. What will happen now is there will be further capital infusion. So all those things will happen on cost basis as and when those things happen based on your regular measurement and recognition and measurement. Mm. Correct. So that is a position as a management you can take, okay. But as an auditor, you don't know what the outcome is, and and you know the reality of the day. The question is whether, see, end of the day you can sign on whatever financial statements we want, right? With whatever opinion we want. But the thing is whether we have adequately addressed the risk and whether we are comfortable signing off the way it is signed off, okay. See, the standard specifically states that do an assessment for 12 months, which in its terms is reasonable because you can't look at perpetuity. And based on your assessments, you will make an assessment whether the company will stay afloat based on whatever are the criteria, and then you will take a position. So that again, end of the day, boils down to how you look at it and what is acceptable and not acceptable to you on the management from a management perspective. But you will need adequate documentation to substantiate your compliance with the auditing standard when you are taking such a position. Mm. Mm. Yeah, mm. No, these things can happen, right? So then you look at it as and when those rulings come out and then account for it appropriately. No, but you don't know whether those, see, that's a contingent liability right now, right? It is not a liability which has devolved on. Could lead to it. So that's something which you need to evaluate. But the thing is, see, the moment you say that it is currently a contingent liability, then the probability of you have made an assessment that there's a probability that it might actually not become a liability. That's why you're disclosing it as contingent liability, right? Otherwise, you're required to have recorded a provision, and if you have recorded that provision, then you don't have the you probably will not have the cash flows to actually meet the liabilities, right? And it can also happen that they could get infusions and stuff like that. So you'll have to do a more detailed analysis before you close out on that. Okay, so since you guys have asked more questions to me than I have asked, I'll move to the next topic. On what? Which issue? That's what we discussed now. No? You will have to evaluate for.
But the opinion of our.
This is not the opinion of, okay, the standard is I can, whatever I spoke is what is there in the standard. It is just that I didn't read from the slide, which I usually don't like, but yeah, I can run you through that as well. All the topics which we discussed were probably I wouldn't say a verbatim reproduction. It is basically what is there in the standard is what we discussed. That's exactly the standard. I don't know why it's not working. Screen lock. Okay. So now that you feel satisfied, we'll quickly run through the slides as well. The system is not cooperating. So we discussed about material uncertainty, and we spoke about risk assessment procedures. What are the internal indicators, external indicators? We need to evaluate management's assessment. The period of assessment needs to be about 12 months, and we need to extend that period by whatever time we want. We said we have to validate all the assertions which are required to be made by the management, evaluating the reliability. I don't know, it's not working. Okay. And okay, one point which we probably missed was you need to communicate this to those charged with governance, which is basically the board of directors, when on your assessment and on the conclusion. And then you have these auditors' conclusion, which we basically spoke about, whether adequate disclosures have been made and stuff like that, right? So we covered everything, in fact. So we spoke about that supporting party, extent of support, and all those things. So that's why I told you when I started as well. Okay, so auditing standards are just a codification of common sense. Okay, so when we discuss it, basically appears like common sense, but that's what they have written in the auditing standards as well. But sometimes we actually fail to follow it. That's where all the issues come from. So is there a break, or do I continue with the next topic? I don't know. I don't know this. I'll continue. Okay. Okay. So next topic is on estimates. Okay. So again, this is also, relatively. I mean, like there are a lot of subjectivities, etc., surrounding estimates. Okay, but end of the day, this is also a very commonsensical and a very straightforward topic that you would effectively need to look at. So I don't know why it's not in this mode. Just give me a second. It'll work on that. This sticker is not working. It's unable. Okay. Okay. So again, let's probably discuss and brainstorm a little bit before we go into the standards per se. Okay. So what do we call an estimate? What are the items we call as an estimate? Yeah. Provision. Okay. Provision for bad debts. Anything else? Okay. Indicative measurement. Then. Okay. Accounting of inventories. Okay. Okay. Measurement of certain uncertainties. Okay. Anything else? So I won't take so much time. We'll finish at 11:30, so we'll rush a little bit. But anyway, anything else? Useful life. Okay. Well, what are the other items of estimates? Let's start with the examples. We can go to definition later. Okay, employee benefits. Okay. Anything else? Very common items have not come, especially after Ind AS. Warranty. Okay. Then because of Ind AS, what are the things which have come up with respect to estimation? Sorry. Sorry, I didn't hear you. Can you tell me again? Earned leave valuation. Okay. But that was there earlier also, no? Under AS also it was there. What else is there? Expected credit loss. That was unexpected answer. Anything else? No, somebody told and then they just went mute. Fair valuation. Right? So fair valuation of what? Okay, financial instruments fair valuation. Okay. Anything else? ECL he covered. Yeah. Then. Okay. Fair valuation of liabilities, everything, right? And anything which requires to be stated at fair value, primarily, let's say, financial assets, financial liabilities, investments, everything. And if you are holding your fixed assets also can be held at fair value. If you do that, then fair valuation of fixed assets and all this, right? Sorry? Yeah, impairment of assets. ROU asset. In that fair value, this thing is there. Estimation is there. Fully estimate. Okay. No, you might be right. I'll just ask this. Doesn't mean that you're wrong. What has that got to do with fair valuation? That is accounting. We presume that we know accounting and we are now talking about auditing. Okay. So I think we have broadly covered it, right? So if the value of an asset or liability, okay, is basically determined based on certain inputs and certain expectations of how that asset would be, because you don't have a direct clear value or a liability would be, because you don't have a clearly identifiable value towards that. So then you basically go and estimate. Okay. So you don't, let's say you have sold, let's say the company manufactures a car, okay, and that company sells that car at a fixed price. Okay. So now this is a known transaction, right? So the value of that car is 15 lakhs. I sell that car for 15 lakhs. I get cash for 15 lakhs. There is no problem, right? So now instead of getting cash, okay, now let's say I have sold this car and I have got 15,000 shares in the company to whom I sold this share. I mean, sold this car, okay. So now, what will be the value of my sale? Value of those shares is that fair value of that share, okay. Then, so we are the manufacturer, we are looking from our books, right? So I had this car, I sold this car, and for that car, and let's say this is the first car I sold, okay, and for that car, I have received 15,000 shares in the company to which I sold this car. What is the value of sale? Somebody said fair value of shares. Anything else? And let's say that company is a private limited company, okay, and you don't have the financial statements of that company. That guy has refused to give you his financial statements. Okay. Sorry? That is the cost. No, that's not your sale. You would have sold with some margin, something you would have done. No, and probably that car is not popular, you will sell it as a loss also. Hmm? Hmm. 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 Okay. As I told you earlier, I am not going into the accounting side of it. Okay. We are not going to look at whether the consideration for the car should be the selling price of the car or the fair value of the shares. That's not the objective. It is just to bring out the complexity, okay, with respect to a transaction. Okay. So now if you have sold that car for 15 lakhs, you know that you have sold that car for 15 lakhs, you have recorded the sale at 15 lakhs, right? But if that 15 lakhs is not determinable, then you will estimate it, right? So what will I do logically? Let's say this is the first car I sold. I don't have a track record of the selling price of my car yet. Okay, this is the first car. This is the first car I manufactured and sold, and this model is what it is, right? So now the value of sale, okay, could be the value of those 15,000 shares which I have got, okay. And how would I determine the value of 15,000 shares? It is nothing but that value of the company in proportion to the 15,000 shares I have got to the total number of shares in that company, right? That's one way of looking at it. Sorry, no, that's just to complicate things, okay. Let's presume we did get it, okay. You go to MCA, if they file the returns, at least last year financials you will get, okay. So based on that, you have determined that you've got some value, okay. You know the business. So now that the person to whom you are selling, okay, or let's say you are the company, right? Now I'm coming for audit, okay. You are saying that the value of this car, or rather I have recorded my sale, okay, at 15 crores, okay. Let's say you manufactured a small hatchback and sold it, and you've got 15,000 shares, and you are saying that the value of that car now, or the sale transaction which I have recorded, is, let's say, 15 crores, okay. So now what will you do as auditor? I don't know. No, I made a nuclear powered car. Tell me. The cost of my car is 15 crores. I mean, I have recorded a sale of 15 crores. What will you do as auditor? Now see, we give exaggerated examples to understand the concept, okay, because we feel it is ridiculous, it can't be like this. Then we get into a thought process to what? Sorry? Okay, let's say I'm not going to apply it on the road, I'm just going to use it inside the factory. For that, registration is not required. Let's try and answer the question, right? No, he is going to use it inside the factory. I don't have to register, he has to register anyway. I manufactured it at 10 lakhs. So that's what. So I'm saying 15 crores is the value of the share. So as auditor, what will you do now? Okay, that's one. Whether it is sold to related party, good question. Then okay, all that you have to do is to see whether that value of that share is reasonable, right? I am calling it 15 crores. Probably somebody might not even buy that shares for 15,000 rupees. That you don't know. So what are we going to do? We have to validate whether that company is actually worth that 15 crores or that 15,000 whatever, which you don't know. Okay, so the client has recorded 15 crores. Now you have to go and test it, right? So how will you test it? So effectively there would have been a share valuation. Let's say that company is in what? Let's say that company, let's just take the previous aqua company itself, right? Let's say that company is into export of aqua food. Okay. So now what will you do? You will see what is the value of that company. How will you determine the value of the company? There will be an EBITDA multiple, industry EBITDA multiple. So you will say industry, let's say there is a EBITDA multiple for aqua company. Let's say is for example, let's say 12 times. Okay. You will see what is this this company's EBITDA. Let's say luckily this company has a positive EBITDA. Then you will apply that. I mean, when I say you, it's the management, right? This time now I'm just referring to the management. The management will then apply that 10 times EBITDA to the company's EBITDA and say probably this is 15 crores. Okay, that company had a EBITDA of 1.5 crores, 10 times that, correct? No multiplication. Yeah, that is 15 crores. Okay, so this is what has come. Okay, so now when you are validating this, what will you see? You will effectively validate the inputs and the assumptions. Okay, number one, he said this company is in aquaculture, aqua food manufacturing company. So what will you do? You will actually go and check whether that guy is in that business. Okay, because if that guy is not in that business, okay, then you will not be able to take the industry multiple for an aqua food company. Okay, so you will go and see whether that guy is, if it is your client, you will know. If it is somebody else, then you will at least have to see whether that is right? So the input first here is, it's an aqua feed company. So you will see whether it is aqua feed. Then the client has said 10 times, and we will have to go test this 10 times. So you will look at all the listed companies which are there, recalculate what is your EBITDA multiple. And then I'm just telling it easy, it might be a little bit more complicated just for understanding purpose I'm saying that. So you will take that EBITDA multiple and see whether that 10 times is right or not. Okay, and then that company's profit was EBITDA was 1.5 crores. You actually have to see whether that 1.5 crores is correct or not, correct? So that's all you will do. So effectively, when you are auditing an estimate, or that estimate could be fair value, that could be different things, right? So you will the most important thing is in testing whether that inputs which have gone into that model of fair valuation, okay, or estimation, whatever you call it, okay, is right or wrong. So we are not experts. Now let's say there is a ESOP valuation. Okay. So they have used Black-Scholes valuation to get what is the value of that ESOP. When I studied CA itself, I skipped that. I didn't understand that formula. I couldn't memorize that formula. I skipped that. Okay. So now we have computers and specialists who basically do that. Okay. So now you will not be able to probably understand how that formula works. Okay. But at least what can you do? You can see whether whatever inputs which were put into that formula is right or wrong. Right. So that is your responsibility. Okay. Next thing is, we are saying they use the formula. Okay. Now let's say in that ESOP valuation, there could be multiple methods, right? There is this binomial model, there is this Black-Scholes model, and there is the option pricing model. There are so many different models, right? So now, and each model will give you a different answer. Okay. Then it is your responsibility to then check whether the model which is used in that estimation is an appropriate model or not, right? So you will see, if you don't know to do that, recompute that testing yourself. Okay. So then what do? We will check whether everything else surrounding that is right, to put it in a very crude manner, right? Whatever is going in, whether it is right or wrong, and whatever is used, that concept, okay, is right or wrong. Okay. Then if it's a huge number, then probably you will have your own experts whom you can use to recompute that and check whether what the management is given is right or wrong. Okay, this is one thing. Okay, but again, whenever we talk about provisions or estimates or whatnot, okay, there's a significant amount of subjectivity in that, right? So now let us say, when we said that EBITDA multiple, for that in our earlier example, when we spoke about that EBITDA multiple, we said it is 10 times, right? But how did we arrive at that 10 times? Okay, it could be in the range of 10 to 12 times, depending on the size of the company, nature of business, etc., right? And EBITDA multiple is not the only way in which a company could be valued. It can be valued through discounted cash flow method also. Based on the future earnings of the company, you will discount it to current value and see what is the value, and to perpetuity, and see what is the value. Okay. So if I do a EBITDA multiple, let us say the value of the company is 15 crores. Okay. Now if I do a discounted cash flow method to perpetuity and find that value of that company is, let's say, 17 crores. Okay. So you have multiple values depending on different models. Okay. So what might effectively happen, okay, is that the management will effectively come to a particular value. They will say it is this, I have taken the average, so probably my value is 13 crores. Okay. But then you as auditor, you will see whether whatever value they have taken is within your range, right? So you would also compute based on different methods. Let's say one is through EBITDA method and one is through DCF method, and you will also say that let's say even in DCF method, client would have assumed that the company will grow by 15% year on year. Okay, you will tweak it and say that probably the industry expectation for that business is only 10%, so it will grow only by 10%. So you will do sensitivities, right? And you will see what is the lower threshold and what is probably the higher threshold, and see whether the valuation which the company has come to is within that acceptable thresholds, then you are okay. But you can't have a situation where your acceptable threshold is significantly material or different. Okay, let's say one value is 100 rupees and the other value is 100 crores. You can't have something like this, right? So that the interval between the threshold should be acceptable, and these are judgmental matters driven again by the principles of materiality, right? So we have this planning materiality, overall materiality, etc. So probably the difference should be within an acceptable threshold, predominantly determined by materiality. Okay. That is the first car that company ever manufactured. Correct. Last day. Next day I sold another car. Yeah. No. This is not that example, right? It is to understand the concept, right? Okay. So to put it differently, now let's say you sold 100 cars during that year, still you have recorded this at 15 crores. Still the question remains as to whether for this transaction, I have actually secured 15 crores if the valuation of that company is right. Vis-a-vis my selling price of another car, that becomes another matter of dispute whether which is the right fair value. Okay. So again again these are two different price points, and whatever you determine should be within that price point. Okay. And that should be within your thresholds of materiality. That's how you look at it. Okay. So again, when we determine any of these things, what always runs at the back of our mind is what? Common sense. Okay. So as long as things are within the thresholds of common sense, then it is usually fine, and auditing standards lays down the principles of common sense. Okay. Okay. Let's go forward. So now you have determined that it is within the thresholds of materiality. Okay. So these are the basic concepts. Okay. So now when you effectively look at this, right, you have certain estimates which are very simple, right? For example, like somebody said, expected useful life of an asset. Okay. That might not be so simple, but it is a principle based on Companies Act, whatever it is that we are following that. So we don't exercise judgment, or there is not significant estimate involved in that, right? Or let's say you do actuarial valuation of your gratuity liability. Okay. So there is this established actuarial model. There is the industry rates of attrition, etc., etc. You will test it, but the veracity of the movement based on the inputs which goes in may not be significantly different. It will be easily judgeable. Okay. So while these are also estimates, these are not estimates which have significant risk of material misstatement, right? So now let us say, let's go back to that your favorite car example, where you have a car which is sold at 15 lakhs, which is 15 crores, right? So now the veracity of misstatement here by this, wrongly determining the sale value is significant, right? So this becomes a significant risk. Okay. So in such cases, you will have to be more careful when you effectively do valuation of these items, right? Or let's say you will have to ensure that the sensitivities which are included are right, the inputs which goes into the model are right, and you will do more work, more from information gathering and model validation to ensure that the ultimate valuation which the management has arrived at is basically acceptable or not. Okay. So again, so the basic principle continues. Whenever you start an audit, you do risk assessment, right? When you are doing this risk assessment, you will effectively determine whether this particular item of estimate is a significant estimate or an estimate which has a significant risk or not. And if that estimate has a significant risk, then you will do more audit procedures surrounding that, basically on account of subjectivity surrounding that item. Okay. So this is what effectively happens. Okay. And okay, so let's say the estimate is wrong, then what do we do? Ask the management, please correct it, sir. They don't correct it, and we can write whatever we want in our audit report, modified opinion, adverse opinion, whatever, depending on whatever is the whatever is the materiality and stuff like that. Okay. So see, the thing is, it looks like a very fancy subject, right? When you're talking about testing, valuation, auditing and accounting estimates, including fair value accounting estimate and related disclosures. Okay. So there are effectively only two things. Okay. Test all the inputs which goes into the model. Okay. See if there are multiple price points, or let's say multiple values which can come, and whether the value that they have arrived at is within that acceptable threshold, and whether it's a significant risk or not, and however you have valued it. Okay. Because there are so many different ways in which something can be valued, please disclose how you have valued it. Okay. Management needs to disclose, and then you will then verify whether that disclosure is adequate or otherwise. Okay. End of the day, that is all which is there. Okay. The complexity comes in because some of these concepts we don't know. Okay. So let's say Black-Scholes model, I don't know how it works. Okay, I know a formula is there. Now with ChatGPT, it is easy. I can just ask us to do Black-Scholes valuation. It does that and gives me, and 90% of the time it is right, right? So those things are available now, so that you know that verification by you again becomes a little bit easier. But some of these things were always an anomaly because it was always perceived to be matters of expert, and therefore we don't know what to do. So the only thing which we should not do, okay, is that when the management gives a valuation report, okay, take it and upload it in the audit file and see whether that number alone matches here. That is not sufficient, okay. So when they give that report, that will have all details of what are the inputs and you know, what are the assumptions which have been made, etc., etc. You will have to then validate whether those things are reasonable or not. Okay, this is the long story short. We will see if I have missed anything, and then we will go through that specifically. Yeah, so another important thing is, you know, so these are all estimates by the management, right? So you will have to see whether there is a management bias. Okay, so let us say, you know, the bonuses of the management are linked to the profitability of the company, and just by tweaking the fair valuation, the profitability could increase, and therefore people could get more bonus. Okay, I'm just giving a very simple, straightforward example. Things could be more complicated. So another thing which you always have to keep in mind is whether there will be management bias and whether there is an incentive to effectively do a higher or a lower valuation, as the case may be. That's important. These things we had covered. Evaluate the degree of estimation uncertainty. That's what we said, right? Whether it is like 15 lakhs to 15 crores, there's a huge difference. So you have to be careful about what you do. Yeah, all these things we have discussed. Okay. The other important thing is which you need to do effectively is, you know, the management would have closed the financial statement, let's say by 31st March, you have another 2 months left to close the audit, right? So if there are any developments which confirms or rebuffs whatever assumptions or any of the calculations which have been used by the management, you will have to do a post balance sheet testing to see whether, let's say they have given you a cash flow projection that in the next year probably the company will make 100 crores of revenue, okay, but in the next 2 months the company has made only 2 crores, okay. There's no way they may actually be able to reach that 100 crores unless it is a cyclical business, right? So those things, some amount of you know, validation based on post balance sheet events also you need to assess to see whether there are any implications on the assumptions which have been taken. Point estimates we discussed. These things we have discussed. Yeah. So the other thing is, you know, return representation, because all these things are, you know, later the management should not come and tell you that, you know, you only told me to assume 12% as your WACC rate for calculation. So please get it in writing from the management that according to them, whatever assumption is there are all reasonable or otherwise. Yeah. No, I think we had enough discussion on case studies. These case studies are a little different, but yeah. So unless you have any question, I think my time's up. Thank you guys.
On external confirmations and audit sampling, our today's speaker is SHOBANA GIRIDHARAN ma'am. Okay, so she is a director and has been with Deloitte for more than 13 years. She has worked extensively in various engagement of multinational companies having shared services in India and domestic companies for technology, manufacturing, healthcare, and power. She also specialized in process documentation, compliance reviews, internal control reviews, and has extensive experience in supporting the accounting and financial reporting processes for various large entities. She has extensive work experience in advisory engagements, including financial reporting and analysis, transition process review, internal control review, and monitoring, control framework review in shared service center, process documentation, shared service organization. She was involved in carrying out review of financial reporting for various geographies at the shared service center in India, process documentation and internal control review. Other key engagements include process evaluation, efficiency review, benchmarking of process with the industry, and identification of the process improvement. So she has majorly the key client she has served is L&T, Microsoft Corporation, World Bank, CMA, GCM, Philips, GBS, and so on. She is a member of ICAI and Certified Information System Auditor and Commerce graduate. Let's welcome SHOBANA ma'am. I would like to call CA Rajesh G for facilitation. Yeah. Handing over this session to you, ma'am.
So, the morning session was a little more, I will say, a technical ongoing concern and estimates. Now it will be a little lighter session covering external confirmations, audit sampling, and materiality. So, these are basic, I will not say basic standards, but very, in every audit, we use the sampling, materiality, and external confirmations. So starting with external confirmations, it is very critical audit evidence, as all of us know, because it includes the key areas to be covered and the period when it has to be covered, and what happens if we receive the confirmation, not receive the confirmation, and what are the different types of confirmation and how reliable is the confirmation, so that basis that we will conclude or we will opine on the financial statements. So as we see the various type of confirmations, we see is positive confirmation, where the confirming party, he will directly respond to the auditor, indicating whether he agrees or he disagrees with whatever is the amount with requested information. Negative confirmation is only if there is disagreement, he will come back. Non-response, most of the cases, especially if we see your payables or your receivables or related parties, it becomes very difficult to get confirmation from those parties. So in that cases, what do we do from an auditing standard? And the last one are exceptions, where you receive the confirmation, but then there is some disagreement between what is there as per your books and what is there as per the financial statements. As per the confirmation. So why do we require confirmation? The auditor, to maintain control on confirmation, he will request what are the the party to whom the confirmation needs to be sent, the address. Now it is through mail, so whether it is coming from a proper domain, and what is the amount. And if the confirmation has not been received, there has to be follow-up request. So follow-up request is compulsory, where you need to follow up with the respective party for the confirmation. Post which still not received, then we do alternative procedures. But there are certain cases where alternative procedures alone will not suffice. Still you need to get the confirmations, mainly bank confirmations, where most of us know that we get 100% confirmation from the banks. It is not like receivables or payables, where we end up doing alternate procedures. So what happens if the management does not allow the auditor to send a confirmation request? So ideally that should not be the case, because it will definitely end up in a scope limitation. Normally confirmations are being sent, will be the management will support in circulating the confirmations, but there are some, when do you think that the management may refuse or they will not want to circulate a confirmation? So normally, management normally does not refuse to circulate confirmations because it will become a scope limitation where we will say call it out. So where do you think that there might be cases where the management is not allowing us to circulate the confirmations? What? Normal payables? Normally for long outstanding payables, that alone might not be the reason. You're close to it, but related party, that is a very what to say, an area where it is very difficult to get confirmation. And mostly if you see in group companies, whoever is a finance controller in A will be the finance controller of B, so he will say from right hand to left hand, what do you want me to confirm? In both the companies, I am the authorized signatory, so what is it that you want to confirm? And no, will surely come. That when the person is a related party in A as well as B, it will come. But how authenticated is that confirmation? That is a question. Her question is normally related party, they don't confirm. It is like it is very difficult, other than a normal receivable or payable, even if it is group companies, normally to confirm it becomes very difficult. Otherwise, there will be huge reconciling items which you need to close out. For that purpose itself, they don't give the confirmation on time. So what we do is we circulate interim type of confirmation, at least to ensure that we push them to be ready, which we will not get, so that at least at the year end we get the final confirmation from them. So instances where management may refuse is where there is some legal dispute going on with the customer, and in case we are going to send out confirmation, it will worsen the existing situation or something, where the management may request us, like there is a dispute with that party, separately we can cover it through a legal confirmation, not through a payable confirmation or anything, or additional information if anything the management is able to provide, so which we need to validate, like from the what to say, management's legal counsel or from the management lawyer who's representing that particular case, what is the status, and you can get a written representation from the management also. So certain cases where you may not be allowed to share the confirmation, ask the confirmation, in such case where we need to do other procedures. Then that is where where do we use alternate procedures? Mostly, as we said, in your payables, in your receivables, where we roll out the confirmations, but we don't get that confirmation from the particular debtor or the creditor. So in case of trade receivables, you will definitely examine your subsequent cash collections. So whether the amount has been collected, to ensure that yes, whatever has been sold, whatever has been shown as receivable as at the year end is actually collected. And for your payables, of course, the subsequent payments you will see. And for your all your bank balances, it is mostly your reconciliations which you will cover as part of your testing. So this we covered. So next important aspect is not only circulating confirmation, but how reliable is your confirmation from. So gone are the days where we used to send hard copy, receive hard copy. Now everything is through mail. So one thing is, you should ensure that the confirmation is directly being addressed to the auditors, not routed through any management personnel. We don't call it as a direct confirmation. And it has to come from a proper authorized person, from the person who's confirming the particular balance. And also it should not be from any suspicious mail or from a suspicious or unknown domain. So if the confirmation is being sent by any person who is not actually authorized, then that will also become a case for us to assess whether at all that confirmation received is reliable. So in addition to that, what do? We normally send out confirmation and we receive confirmation. So additional procedures or additional steps do we do to ensure that whether that particular confirmation is being received from the right person? Or we just get the confirmation and just tie the amount and put it inside our file? What is expected, or what as auditors we do when we receive an external confirmation? Correct. So one thing is where you have a receivable or payable, already from an audit, you would have assessed the recoverability of those receivable, whether you have adequate provision, whether that party is able to pay you, or are you still supplying without receiving your old dues. All that will be part of your audit procedures which you perform. But specifically for confirmation, um, one thing, as I said, the authorized party, whoever has sent the confirmation is the person who is supposed to send the confirmation. And the other thing, whether the domain address, whatever is being through from which the confirmation has been received, you will also try to check it with the official website of the confirming party. Yes, whether this party is a person who has sent it from that official website. Then for non-responses, we already covered for non-responses with respect to trade receivable, what do we do? With trade payable, what do we do? Then we have bank borrowings. So there you will see your agreements, your loan agreements, your covenants. There should not be any breach of covenants. So all that we need to look into in case of non-responses. So in case of investments, because we send for receivables, payables, banks, investments. Investments, we normally check the bank statement, the demat account from the custodians, and then whether any interest is there on those investments. All that we check as part of confirmations. So when in case of a positive confirmation, especially it is very, very critical when you send out for banks, there can be some off balance sheet items, right? Like your guarantee, your letter of credit, and your performance, which normally they don't cover as part of confirmation, which we will also require the banks to confirm, because they will have an impact in your contingent liability disclosure. So that is one angle which we need to see, because mostly if we see banks, they will only confirm the current account and they will send it to us. But there will be some CC which is there, cash credits which are there, then performance guarantee which is there, fixed deposits which are there on lien, interest. So the way you are drafting the confirmation, what all information you require is also very, very critical, so that whatever you are asking will only be confirmed. If you are only going to send bank balance confirmation, they will only confirm the bank current account bank balances and send it back to you. So our confirmation that we send has to be exhaustive, capturing all items which we require from the financial statements perspective, so that we don't miss out any account balance which needs to be confirmed, because external confirmation is a very, very critical audit evidence apart from the testing that we do. So of course negative confirmations is where only when there is a disagreement the other party is going to confirm. Then whatever is the confirmations which we obtained, that, as one of the person said, evaluate it with whatever is there as per the books. For example, if it is from banks that you are getting, so what else you will see? You will see the agreement, you will see the covenant, you will see whether there are undrawn credit facilities. So whatever is there relating to that particular account balance in your books. Then if it is a joint venture or an associate, from there you are receiving the confirmation. What is a profit sharing? What is the agreement between the joint venture? And if it is, say, a real estate, for the contracts which is getting confirmed, again it is going to be the contract terms. Are there any waiver conditions? Are there any penalty conditions? Is there any retention in that contract? So all these will be confirmed as part of the confirmation. So one thing what we want to clearly look at is how are you going to design your confirmation request, because the last part is very, very important, where you should have a clear objective. What is it that you want the client to confirm to you? So you have to select the appropriate confirming party, whether the confirmation is getting properly addressed, whether it is contains the relevant information directed to the correct person, checking with the client, containing all what I told, off balance sheet items, any other items, any agreement related which you want to understand, everything you can incorporate that into the confirmation request and send it to the third party for confirming. So these are all once you are not receiving the response, of course, follow-up request also has to be done, and that also has to be part of your documentation in the file saying that the confirmation has been sent, but there was no response, there was a follow-up, and then alternate procedures done to substantiate that we have not missed out on any of the procedures. So in your confirmation, the key thing is your presentation of the confirmation request, where we mentioned the key amounts, the dates, what are the account balances, and in certain cases they specify the amount, but it is recommended that the amount is not specified, because the party who is confirming, it is better for the party to confirm and then for us to trace to the books than we specifying the amount and sending it to them. And if it is the person is not the right person or something, what is a return ID to which this confirmation request has to be sent in should also be mentioned. So these are the ways or means through which you have to send out your confirmation. And whenever you're sending out the confirmation, you have to use a controlled, secured environment, and wherever possible, encrypted digital signatures, so that there is no tampering or anything which happens in the confirmation that is received. It cannot be changed or modified. So all these are generic about confirmation. And in certain cases, what happens is where you send out, I'm just touching upon only key things with respect to confirmations. So where you are sending out confirmations to third parties, there can be restrictive language also used in the confirmation, right? If you send it to some lawyers for some confirmation, they will definitely place restriction, like the confirmation is solely provided only for the use of this particular purpose, it cannot be referred to anywhere. So can we consider those sort of confirmations having restrictive phases for our purpose, or should we say that we cannot consider all those having restrictive phases, we want a clean confirmation? How is it? So so that is left to the discretion of the auditor who is actually doing it. When the confirmation has a restrictive clause, so even though there is a restricted clause in the confirmation, it can still be taken as an evidence if the auditor believes that whatever is being communicated in that particular confirmation is factually correct. So in that case, what should he see? Whether the confirmation has come, which we saw on the earlier slides, it has come from the correct source, the authorized person, from the official ID or the domain, and it is encrypted. There is no risk of alteration of whatever has been communicated, and it is what to say, the template which has been shared by us has been properly updated and getting shared. When you compare the other confirmations in case received from the company, it is not the similar one, like the same type of wordings or the same type of format which is getting repeated and just a signature alone getting affixed, because for each legal the amount will be there, the amount will vary, but the reason or the legal dispute will also be little different. So there we have to exercise our, as he mentioned, as an auditor, what is it that you do to ensure that if there is any restriction which is placed in the confirmation, that is related to that particular case or that particular type of an agreement, and factually whatever is contained in the confirmation is correct, subject to whatever we discussed now. It is done by an authorized person from a proper domain, and whatever has been requested has been confirmed, and there is nothing that is being tampered or altered or modified. We saw the alternative procedures which we need to perform. Definitely there will be some exceptions noted in the confirmations. So as an auditor, whatever are the exceptions which have been noted, that has to be looked into if it is on account of some timing differences. Like I would have recorded as a sale, but the person who's actually taking it as a purchase, there would be a cutoff for him. So in that case, if we are convinced that it is a reconciling item, those are goods in transit, it is fine for us to have the difference in our books and have a reasoning saying that the reason is because of the delay in the dispatch, or the goods are still in transit, that is why it is still not getting recorded and confirmed by the other party. So negative confirmations we saw, and we will now get into some case study, because as it is this external confirmation is a simple direct one. So if you go into case studies, you will be able to understand what are the different types of scenarios which we come across. So this is negative confirmations. During the audit of Sunrise Traders, auditor planned to verify trade receivables amounting to 4 crore through negative confirmations. So I will not mention any amount, I am sending out the confirmation. If there is a disagreement, then the customer will come back. As the customers were numerous and balances were small, the engagement partner needed to ensure that this method alone was appropriate for obtaining the audit evidence. So negative confirmation alone, is it sufficient? Negative confirmation also will be sufficient provided we carry out these ABCD steps. So where we mentioned that it is a small account balance only. So the risk of, you will do your risk assessment initially for that particular account balance, and when you conclude that your risk is low and your controls are also effective around that particular account balance. Secondly, the entire account balance consists of only small items and they are all homogeneous in nature. There is not much differences in whatever is in the transactions. And based on your past historical trend, a very low exception. What is tolerable and what is actual, a very low exception only you have noted. And only if there are differences, you are going to get the confirmation back. Otherwise, in most of the cases where you have rolled out the confirmation, if the party is agreeing with whatever has been mentioned, then you are not going to get any response back. And this has been the trend with the company over the years. So in those cases, when the auditor is satisfied that yes, all these conditions are being verified and it is under the control, then you can consider this negative confirmation alone as a reliable evidence. Next is on your positive confirmation. So there you will mention the amount, and then the party, if he disagrees only, he will respond back. In positive confirmation, you will not mention anything, you will just roll out the confirmation. So Messrs. Gamma Limited noted a lack of segregation of duty in accounts receivable process. Specifically, CFO had the authority to prepare and approve adjustments to accounts receivable aging without independent review. So this enabled the CFO to manually adjust the aging report, delaying bad debt recognition to present a more favorable financial position. Due to these concerns, auditor suspected material misstatement and decided to send positive confirmation. So there is a reason for the auditor to send out positive confirmation, since he is thinking that the CFO is actually manually working on the aging and not allowing the provision to be recorded by changing the aging of the receivables. So in that case, he decided to send a positive confirmation. So when a response to a positive confirmation is necessary to obtain sufficient appropriate audit evidence, alternate procedures cannot substitute for non-response. So because there is a control issue here, and as an auditor you have circulated confirmation, but the debtor has not responded to your confirmation. Normal scenario, when there is no control issue, when things are fine, when debtor is not responding, we do an alternative procedure. But here we see that there is a control issue, and we have come across that there has been change in the aging of the debtors, because of which we have not considered provision, and we are circulating confirmation for which we have not received the response. This will definitely impact the audit opinion, and if just by performing alternate procedures you cannot close this, there will be a scope limitation in scope, and we need to see how we have to bring it out as part of our opinion. That depends on what is the materiality, what is the impact on the financial statements. So the background is just to say that if there is a control issue and if we circulate confirmation and we are not receiving the response, then what it is as an auditor we need to do. Because normally our thought process will be, we send a confirmation, we don't receive a confirmation, do alternate procedures and close. But what is the impact? Whether there is a problem in the system itself, in the business itself, that angle also has to be evaluated. The third is on the management's refusal to allow confirmation request. So where the auditor planned to send positive confirmation to verify major receivables from overseas, but management refused to permit the auditor to send these confirmations, saying these are all confidential business relationship. So in that case, it is definitely a limitation imposed by the management. So what happens where, in that case, the auditor is not able to get sufficient and reliable evidence for him to conclude on the financial statements. So he has to communicate to those charged with governance and what is going to be the implication on his opinion. And management's refusal. So in cases where we saw, because of litigative reasons or any other business reasons, if the auditor is satisfied that the response which is given by the management is fine, then go in for alternate procedures. Otherwise, if we see that it is purposely, management is not allowing us to circle out the confirmations, telling some reasons, we cannot just go ahead saying that it is confidential business relationship, so we have not circulated, and go ahead confirming, saying that there is everything, we have just performed the alternate procedures and closed out. So it becomes very critical to ensure that whatever confirmations have been circulated, response has been appropriately received, and where not received, we are properly documenting and closing out the loop, sending up, following up on the request, and then the closure. Where you have exceptions in the confirmation circulated, say there is a debtor confirmation where it showed a balance of 9,50,000, whereas in the books it reflected a balance of 10 lakhs. So initially it looks like a misstatement, but as I said, it is because of a timing difference, where there was a difference, and further when as auditors we looked into it, the difference arose due to timing difference, where XYZ recorded a sale upon dispatch of goods, whereas the other company recorded the purchase only when it has actually inwarded the goods. So that is a reasonable or a valid timing difference, because of which there is a difference between the balance confirmed and balance as per books, because of which you don't say that it is a misstatement. There is an exception, but that is not a misstatement. So next is the reliability of the confirmation. This also we saw through, where the auditor received confirmation replies from several customers via email, but upon closer review, emails appeared to have been sent from unofficial domains like personal email IDs rather than company's address. So in that cases, definitely as an auditor, we have to look into how reliable is this information. And you also perform additional procedures by reviewing subsequent payments, seeing your original invoices. Then you confirm your communication with the customers, directly call a few of them and confirm that this is what has been confirmed and whether it has been received from them. You also check in the official website whether that company is actually there, and then why the person has to use a personal mail ID to roll out the confirmation. So certain aspects which we need to see before we conclude on our opinion. So this is on control over external confirmation, where company's finance head sends out confirmation, balance confirmation directly from the company's email system, and then they forward the replies to the auditor. So later discrepancies were noted between the management record and the confirmation replies received. So in the first place, confirmations have to be direct to the auditor. It can't be routed through any management personnel. So as an auditor, you have to maintain control on what is the information that you have actually requested, who are all the confirming parties, and the layout of the confirmation template, send out the requests including the follow-up, and allowing management to send or collect confirmation definitely compromises reliability and independence of the evidence. So it is, even as we do our audits, most of us, we know that we have to only get direct confirmations, and even if it is received by the management, they are only forwarding that saying that I've only forwarded, I have not changed anything. You see the timestamp, it has come and I've just forwarded it in a minute. It is not considered as a direct confirmation. We saw management's refusal to roll out certain confirmations, whereas an auditor you have to inquire what is the reason for the refusal and whether there are valid reasons for refusal, and only if as an auditor we are satisfied yes there are reasons for the management requesting not to roll out confirmation. One example we saw was on that if there is any legal case. Another is to the government departments, where most of the government parties we will not receive confirmations. So but that doesn't mean that we should not circulate any confirmation to government parties. But of course whatever information the management has, like the management whether they are having their reconciliation with the customers. In case of power generation companies, that they have in that what is it in the portal itself, what are the receivables for the whatever is the unit of power that they have sold to the government, and what is the receivables pending to be received. That tracking is also there. So the third party, the website through which we can at least download and see what is the exact receivables which is outstanding, even though the government has not confirmed what is the receivable. What are the subsequent payments that have been received? So these are some of the things which as an auditor we can verify, even though the government party is not confirming the receivables to us. The best way of confirmation is the blank or positive confirmation, where we send it to the party without any specifying any amount, because then whatever is it is time consuming for the other person, it is an increased effort from the other person, but that is the best way to ensure that whatever is there in the books of the other person is being communicated correctly. Otherwise if you send the amount, then it is a responsibility on your side saying that this is what it is in my book. So it doesn't bring out the real purpose of confirming that particular balance. So blank or positive confirmations are the best way of confirming, and at the same time, as I said, not only restricted, for example a bank balance, don't restrict it only to your current account, it has to cover all other financial aspects also, like whether there are fixed deposits on lien, whether there are guarantees, the off balance sheet items if any, that also has to come as part of confirmation. So again, if any confirmation is coming from a third party, where it is maintained and managed by a third party, as an auditor, definitely from the source from where the confirmation is coming, whether the person is authorized to confirm that balances, then there is no modification or change in anything that is getting confirmed. So all these aspects we need to look into before getting it finally into our files. Then this non-response. For example, we have circulated some 50 confirmations, and in that case, how do you categorize and evaluate? You would have not received confirmations for all the 50 parties. So there, as part of our procedures, we split the agreed responses we have received from so many customers without any exceptions. Few customers where the mail IDs were not clear and they were returned. Few customers where there were non-responses, so alternate procedures have been performed. Few confirmations where there were exceptions, but however further validation, these were actually not exceptions and we have closed it in our audit. So we need to clearly break down the various confirmations received and the validation of all these confirmations. So this is pretty simple. Any questions in that? Otherwise we'll move on to the next, because these are I can say looks to be easy accounting standards, auditing standards, sorry, but very, very critical for our opinion, because external confirmation is a very, very key factor. More than our audit procedures, we rely on, because it's an external evidence, it is very critical that we perform proper procedures on the same. So anything, or we will move to the next. Can we move to the next on materiality? Materiality also, as in morning when NACHIAPPAN mentioned, like there are tolerable limits through within which we can take a call saying that if there is a threshold or if there is a tolerable misstatement, I can still go ahead. I can live with that tolerable misstatement because it is not going to impact materially. There is not going to be any material misstatement in my financial statements. So this materiality is one key factor which is very, very critical, especially for performing the audit, for deciding the procedures which you need to perform, basis whether it is a high risk, low risk, and when do you need to perform these procedures, whether during the interim or as at the year end, and the samples that we need to actually test. So when we talk about materiality, it is mainly the how significant are the misstatements, individually or collectively. Individually, it may not be a material misstatement, but when I'm collectively combining all the misstatements, whether it is going to be material for me, so that in such a case, how it is going to impact my opinion. So this concept of materiality, this has to be applied both during the planning, and it has to be relooked or revisited at the final stage also, because you would have taken your materiality basis your interim trial balance or interim financial statements, basis the progress and how the operations have gone. Because we will cover the benchmark and other things, because if you take profit as your benchmark, you would have taken the projected profit, budgeted profit, then you should actually see what is your actual profit as at the year end, and whether you need to revise your materiality to see whatever you have tested till now basis your projected profit holds good. If you have tested additional samples, no issues, you can continue with whatever was your projected profit which you considered as a benchmark. But where you end up in a reverse, where you have used a projected profit, however basis your actual profit you have to test increased samples, then in that case your materiality has to be revised. Otherwise you would have not covered the sufficient, because when in our audit report we clearly mentioned we have verified sufficient and appropriate audit evidence. So your audit evidence would have not been sufficient if you are not revisiting your materiality. So this we will cover in the subsequent slide, as this we already covered. Like, what is the purpose of materiality is to determine your nature, timing and extent of your risk assessment procedures, and what timing and extent you have to use the audit procedures. And as we said, materiality should definitely be reassessed individually as well as collectively. So when we say materiality, the most important thing is not only the account balances, not only basis the amount, but also qualitative factors needs to be considered. When we say qualitative factors, it is your related party transactions, or if it is your major segment, or if there is any changes which is coming out as part of accounting policies which is going to impact any particular account balance. So those qualitative factors also needs to be considered. So we will cover this in the subsequent slides, but various benchmarks which will be used for materiality is your assets, your revenue, your expenses. It depends on the type of the industry. So most of the listed entities you will go in for PBT, and certain FMCG related clients where your top line is most important, your revenue is very, very important, those type of clients you will go in for revenue. PBT mostly if it is listed and if you are paying dividends, that is what the stakeholders will look into. So you go in for profit before tax as a benchmark. And in case of cost plus entities mostly you have your service related entities. The payroll cost will be the major cost. In that case, your expenses will be your benchmark which you consider for materiality. So what we are trying to tell here is your benchmark for materiality will vary depending upon the type of the industry and type of the company that we are looking at. If it is a say on NBFC, so your loan book is going to be a major account balance. So in that case, your loans will be your benchmark. Your assets will be considered as a benchmark for materiality. So it is very, very critical for us to identify which is the correct benchmark for us to consider for materiality. Some companies use, as we mentioned, PBT, revenue. So PBT is where the dividend paying entity, it is a listed entity. If you see revenue from operations, any compensation, critical compensation which is tied directly to your revenue, then expenses we saw cost plus as we mentioned, and EBITDA assets. So I've covered all this. It will vary depending upon the nature of the company. So here XYZ is a listed company engaged in automobile manufacturing, and these are the financial metrics. We have revenue, we have total expenses, PBT, assets, equity. So as I said, for a listed entity, we go with PBT because that is where the focus of the users will be. And if it is a dividend paying company, straight away it is PBT. So it is more left to the judgment, like which we will consider for materiality. So when I conclude that yes, PBT is going to be by benchmark, I take 25 crores which is my PBT, and there is a threshold for materiality if I am using my profit before tax. So I apply the threshold, and the performance materiality which is 80% for the particular account balance. How do I determine this, whether it should be 80 or whether it should be 90? When I say this performance materiality, how do we determine that? Sorry? You're close, but instead of the customers, that gap of the whether it is 80% or 90% is primarily based on the gap that is basically for the expected errors that may come in. There will be corrected misstatements, uncorrected misstatements. So historically, what has been the trend? So that you have to consider for determining whether you want to keep it at 80% or 90%. It is purely based on the errors that has happened in the past, which will determine whether you want to keep it at 80 or 90. It can be both corrected, uncorrected. It can be audit adjustment entries also, where management has not recorded those entries, and we as part of finalization have given all those entries. Still the management went and corrected. We have to see that history, and accordingly you have to fix the percentage of 80 or 90. Because anything what you do, there has to be a basis of why we are considering. So this is another, again, it is a private company. That one we saw was listed. So we are just trying to use an example to see how we are determining the materiality, where these are all the key numbers in any financial statements. So this is a private company. So because this is a private company, you can, if you see the profit, in year 24 it was 52 crores. In 23 there was a loss. In 22 there was a loss. It is volatile. So we just say that the profit is volatile. So the next closest benchmark or the best benchmark will be revenue, because it is a private company and the top line will be very critical. So in that case, you consider revenue as your benchmark, and when revenue is considered, the threshold is 0.8 to 2%. And so again, whether you want to keep it at 80% or 90% depending upon the errors, trend of errors. And the last is going to be your clearly trivial threshold. So the last, whatever we are seeing as 5%, for when you're testing, what is the significance of that? What is the significance of the last 5% which we are seeing? That not materiality, that will come. Correct. So what are we trying to conclude here is, when you're doing your test of details, you are coming out with differences, right? So when your individual differences in your sample, when you're testing a sample, is going to be more than my that 5%. As he said, when you're going to aggregate it, it is going to be more. So at that level, it should not exceed my 5%. Where I individually test the sample. Say I test 50 invoices. And 50 invoices, at each individual invoice, I should not get a difference of more than my threshold, which I have mentioned. If I get a difference, I have to look into and see what is the reason for that. I cannot just close by it. Okay, fine. I had done the testing. Individually, say for 50 samples, each individual sample, it did not cross this threshold. But some 6 or 7 samples where there were differences, when I accumulated them, it is crossing, then that is also a concern for me. So what is the reason for those differences, whether those differences are genuine, or whether I should increase by testing further samples to conclude that yes, whatever I have tested gives the comfort that there is no misstatement in whatever has been, what testing has been performed. So this is also a company which is providing software services. Here what we wanted to see is where you need to normalize. During the year, the company received an arbitration award for a long pending case. So whenever there are some exceptional items, it is a one-off item. When I consider my profit before tax as a benchmark, I normalize the profit by removing those one-off items or exceptional items. Where it is a one-time dividend that I'm going to pay, I'm not going to pay it on a regular basis. So that becomes, and it is a very huge amount to my foreign, say to a, I'm receiving a dividend from a foreign company, and that is a huge amount in my other income. So I can remove that because it is an exception item and I'm not going to receive it year on year. So I will normalize my benchmark, and basis the normalized benchmark, I will arrive at what is going to be my performance materiality and my CTT. So the clearly trivial threshold. So quickly getting into the selection of appropriate benchmark. Like it is a construction company, and what is going to be the benchmark? The company is using profit before tax as the benchmark, but the company has incurred loss because of temporary project delays, while its total assets and revenue remain stable. So in this case, what is the benchmark as an auditor that I should decide? So here you have your assets, your liability, your revenue, all these are given, and your focus is going to be primarily on your profit and revenue. Again, as we said, since the profit is volatile because of your project delays and other factors, whether you should consider any other benchmark. So in this case, the assets was considered as a benchmark instead of profit before tax because it was more stable basis for materiality. So only thing what we are trying to tell is evaluate whatever is going to be the reasonable benchmark for materiality, because if it is too volatile, you cannot consider that. It will keep on changing, and you will not have a clear basis to fix your misstatements clearly, because your benchmark itself will be changing too drastically year on year. So here the auditor was finalizing the audit strategy and decided to determine overall materiality based on profit before tax. So the auditor shall determine performance materiality to reduce the risk and uncorrected misstatements. So as we mentioned, that 80% or 90%, that will depend on what is going to be your gap in your uncorrected misstatements or corrected misstatements, so that accordingly you will have the samples to be tested and to conclude. So this is one more thing where say the management, there was some classification issue, like 20 lakh misstatement in loan classification. So management is saying the loan is going to be a benchmark for that particular company. Management is saying out of 200 crore loan, only 20 lakh is the classification error. Now why do you want to consider that as a misstatement? So the critical aspect here is that is going to impact your debt equity ratio, which is getting disclosed to investors and lenders. So even though the amount is not material, there is a separate disclosure which will impact the users of the financial statements. You have to go in for proper classification to ensure that your materiality, the benchmark considered for materiality, is correct. So from a client side, it may be immaterial, but when we have to look at other aspects also where it is getting impacted in the financial statements. So this is more of when it is a normal normal business and not for profit business, what is the benchmark that you will consider? And the percentage also, as I said, the within the threshold, it depends on various criteria, like the operations of the company, the past history errors of the company, any one-time exceptional items that were happening. So all these has to be looked into to determine what is the percentage you will consider. So this we saw individual. If it is more than my clearly trivial threshold, I have to look at it. But collectively also, if it is going to exceed my materiality, then that is also a matter of concern where I need to see whether I have to test additional samples. So this is what we spoke now, where your overall exceeded your differences exceeded your overall materiality. So here there is one pharma company where overall materiality was 30 lakhs based on total revenue, but the company's focus was on research and development, and in which case a lower level of materiality could be considered was the decision taken. But for that purpose, what are the various criteria to be evaluated? Like whether the items which you have considered are subject to legal or regulatory attention, any specific disclosures which is required to be given, whether it is with respect to newly acquired business segments. So in that case, if it is normal, where you have considered to take a lower materiality than the overall materiality, you have to substantiate with clear reasons as to why you are comfortable with taking a lower materiality. Same way, if there is any change in your, where your management decides to sell a major business division, or you're significantly changing the company's financial position. So as we said, the materiality which is assessed as at the planning should be reassessed as at the final stage to, if there are any changes happening during the course of the operations, that also has to be factored in, and your materiality has to be revised so that you end up testing sufficient samples for your opinion. So here what we saw was initially there was a profit, but however initially we took a profit as a benchmark, but some unusual operations which has happened where one-time sale of subsidiary which had increased my profit to a greater extent. So as we discussed earlier, where there are going to be one-time activity, you have to normalize your profit to arrive at your materiality. So when we started the materiality, the entity, it was based on a percentage of profit before tax from continuing operations. But however, this one-time sale has led to a further increase. So we normalize our profit by removing that particular sale, because it is not going to happen year on year. And you cannot have a different, benchmark for materiality getting considered. It has to be consistent. And here, where we have initially set up 50 lakhs as my materiality and the performance materiality at 37 lakhs, later on there were several control deficiencies and multiple uncorrected misstatements. So in that case, what happens? You will reduce, because you have to end up testing more number of samples, because initially you had a higher materiality, performance materiality, thinking that things were fine. Then subsequently you had a lot of control deficiencies and uncorrected misstatements, basis which you are revisiting your materiality and performance materiality so that you end up covering sufficient samples. So this is on materiality. Again, this is very, very critical, because as we said, we have to test sufficient appropriate audit evidence for us to conclude and provide our opinion. So any doubts in this? In that case, then the last one is going to be on audit sampling. It is clear, right? Because these are all small topics in its own sense. I just wanted to touch upon the different scenarios so that you are able to relate and see how we need to do and what we need to do. Otherwise, it becomes too theoretical. So, next one is on audit sampling. So this everybody will know right from when we whatever it is, sample testing, that is the only thing we will but a lot of things have got changed now. Sample testing is important, but nowadays looking at how the samples need to be selected itself has undergone a big change, because mid-size firm fine, smaller firms they still have their own way of doing the sample selection and testing. But when it comes to big fours, there is a risk assessment which is being done using Power BI or using analytics. So basis the risk assessment whether that particular account balance has a high risk, low risk or whatever, exceptions or outliers are being identified, and basis the exceptions or outliers only the sample testing is determined and tested, because lot of the time goes on analysis of the risk using your tools, your techniques, your tools and other analytics and other Excel and Power BI, and then only we go into substantive testing basis the analysis. So it is more exception driven than just picking some 20 samples randomly, testing and concluding and saying that there is no misstatement. So when we come to sampling, like critical things which I want to touch upon is, what do we mean by anomaly in a sample? When do we say there is an anomaly in a sample? And how do we conclude when we find an anomaly? Okay, a sample which is different from what we have, from what we are testing. So suppose I am doing, I'm testing some 50 to 60 invoices out of a population of 5,000 invoice, and out of that 50 invoice I find some one invoice. Okay, there is some overstatement of some a few lakhs. So that becomes an anomaly for me. Then what do I do? Out of 50 invoices from a population of 5,000, I have come across one invoice which is overstated, which, as he said, yes, out of the total population, that is an anomaly. Now what do I do as an auditor? Do I increase a sample immediately, or do I look into what is the nature of that particular error? Is it a one-time error? For example, say that there was a manual change that was made. Normally, the process of the company is all your invoices will be automated. So there is nothing which can be done manual. But because of some reason, there was one manual entry that has happened, and that is also properly authorized and with appropriate approvals. This anomaly does not become an exception. It is, so we need to document saying that the reason for this is there is a manual update which has happened basis approvals because of this particular reason. Otherwise, the process of the company is all the invoices are automated and there are no changes that can be made. So that case, you need not increase your sample size. But if you are not able to get a proper closure to the anomaly or exception identified, then you have to see that if it is above your your clearly trivial threshold or your materiality when you accumulate all the errors, that case you need to increase your sample size. So there are different methods of sampling. So I'm not getting into in depth of all that statistical sampling, which is your random basis of sampling, and you have your other probability theory to evaluate your sampling. And the next one is going to be your non-statistical sampling, which is more based on your judgment on what are the items, whether you need to select high value items or whether you need to select basis on volume these many count of items. So both type of sample selections are there. What do we mean by stratification? Like correct. So typically, if you say for trade receivables, there is a you have some 20 crore, 30 crore balance. So then you stratify the sample. So from this range to this range, up to 5 lakhs, these many samples, up to which is so more than 10 lakhs, there are in a 20 crore balance, 9 crore constitutes this balance. So there are 10 customers in that particular bucket. So I will test all the 10 customers. Then if it is up to 5 lakhs, this is my number of customers for which I will do some random sampling. If it is from A to B range, then how many samples do I cover? So you basically stratify your sample into various buckets, identifying what is the sample size or what are the samples I need to test for that particular account balance. So you basically divide the receivable balance into groups and see what is the percentage you are going to test, or how many samples you are going to test, and how are you going to pick your samples. What do we mean by tolerable rate of deviation? We heard this, no? It should be within the tolerable limit, tolerable limit. So what is the tolerable rate of deviation? Correct. Tolerable rate of deviation is the limit up to which, as auditors, we are willing to accept that particular misstatement, and beyond which you cannot rely on that particular control, or you cannot rely on that particular audit evidence. So then it becomes very significant for us to see what is the tolerable level of what is the tolerable rate of deviation. Now then, how do we identify this tolerable rate of deviation? So we say that this is the tolerable limit for me, beyond which I will not agree, and there is a possibility that there is a misstatement. It is more towards the account balance that we are testing. What is the controls around that account balance, and what are the risk of errors that has happened in that particular account balance. Say for example, I have some 50 invoices for my approval, okay, and the tolerable deviation as an auditor, I am saying it is 5%. That is maximum of 2 invoice. There can be lack of approval, or it could have gone with only 1 level approval. So I am fixing up a 5% as a tolerable deviation rate for me out of 50 invoices. When I do the testing and I end up having 4 invoices where there are no approval, then the percentage goes to 8%, which is more than my tolerable limit. And in that case, I cannot conclude that whatever I have tested is an sufficient and reliable evidence. And in those cases, as our friend mentioned, we will increase our sample size to cover and conclude that though it has exceeded the tolerable level, additional samples tested does not reveal any further exceptions, and so we are concluding on that basis. So this we already covered. This is more of a correlation between your sample risk and your sample size. So how much of risk is acceptable for the auditor, and if it is lower, if the sampling risk is lower, you go in for a larger sample size. If there is a higher, sampling risk is higher, then it is smaller sample size. So basically on how you conclude on your controls. If you say your controls are effective and you are placing reliance on your controls, you will end up doing lower substantive procedures. Vice versa, if your controls are not effective and if you are the controls are not operating effectively, then you will end up testing higher samples in substantive because you don't rely on your controls. So when you are testing or concluding on your samples, the critical thing that we need to look into is what is the margin of error. Smaller margin of errors, it is fine to conclude if it is within the threshold as we mentioned. And the variability, that is when we saw what is your tolerable limit vis-a-vis what is the actual variance that is happening. If it is not within your tolerable limit, then you have to increase your sample size. And again, the third one is more on your controls. If your controls was effective and it was operating effectively, you will have a higher materiality, so that you end up testing lower number of samples for substantive. Okay, this we anyways covered. Anomaly also we covered. Then this is more on, suppose there are differences in the samples that we tested. We do only, whatever samples we test, we say it is a representative of the total population. So whatever differences we got in our testing, we need to extrapolate it to the total population to see whether that is coming within our threshold. Because we cannot just stop with, there are different 50 samples we tested. Suppose we end up having differences in 10 samples. What will be the impact on the total population? As I said, 50 invoices you tested from a population of 5,000. So if for 50, if I have some 6 or 7 errors, so for a 5,000, how much will be my error rate, and whether that is within my tolerable limit and within my materiality for me to conclude. That is on your, on your substantive testing. Okay, this is fine. So we will go in, these are the different types of sample selection which we saw: a random selection, systematic selection, and MUS, monetary unit sampling, is your statistical method of selecting samples. Some weighted approach is given to items which are having higher values. Then you have block selection. So all these are allowable selections as per the auditing standards. So you can use statistical, non-statistical methods of selecting the samples. Mostly we go in for statistical method because that is, you need not explain your judgment or the basis on which you have done the sample selection, because everything is being predetermined and defined in the tool itself. So this we covered, what is the purpose of sampling, what is the, how do you project your results when there are differences, and example of stratification also we saw through. So all these we covered. We'll straight away go into case studies. Auditor planned to test the operating effectiveness of control over sales. Initially, a sample of 20 invoices was selected. However, the population comprised over 10,000 invoices during the year. So, again, as I said, either statistical or non-statistical method, you have selected 20 invoices, and then you check whatever basis the testing that is done, what is the tolerable level of deviation, what is your expected deviation, and if you see that it is not falling within that threshold, you have to then increase your samples and do increased testing and conclude that you have not identified any additional deviation. Okay, this normally, I think at least what we do is when we select samples, and sometimes what happens, we are not able to get information for particular invoices or one or two couple of samples. What do our juniors, what do? They just replace the sample silently. Sir, you give whatever information you have, I will put it for that sample and close. But that is not the way it has to be done. Replacement is possible only in cases where that particular control itself was not there. Say for example, in a testing, sample testing for payment, you say that the payment was properly authorized by the particular personnel and then only the payment has happened. Suppose that particular check has been cancelled, that particular activity itself has not happened. So you, in your population, in your sample, the cancelled payment got picked. So in that case, it is not at all a sample that has to be tested for you to conclude. So that sample can be replaced using a proper payment sample. So that is where, if it is that is where is the item which can be replaced, but not normal items which are coming as part of your testing. Because the client is not able to support you with the information, you cannot replace with another sample. It has to be a genuine reason that it was a cancelled transaction, and you are also able to validate that yes, that payment was cancelled, it was authorized, and then only by the person it was cancelled, and so although it got picked as a sample, it need not be tested, because there will be nothing to test in a cancelled payment. Okay, so here there is a ABC, a mid-sized firm, who was engaged for statutory audit. During the planning meeting, audit team debated whether to adopt a statistical or non-statistical sampling for testing inventory and revenue transactions. Because I said you can use statistical or non-statistical, any one of which. So what is the basis of determining whether you need to use a statistical or non-statistical type of sampling is where the account balance which you are talking about, say for example inventory, where if you see below, it is low risk, and the transactions are all similar in nature. There is no difference in any particular transaction. If a revenue, the agreement or contract is the same for all customers, the rate is going to be the same, there is the discounts given is going to be the same, there is absolutely no change in any of the agreements which is given to the customer, the authorization process, everything is the same, then in those cases you can use a non-statistical sampling method. So judgment basis you can select the sample. But if it is complex, and if it involves for example, the revenue itself, the contract model varies, agreement itself is varying from customer to customer, location to location, and the rebates or the discounts that you give is also going to change location to location. So in those cases we cannot go by a non-statistical method, because it is complexity is involved in that particular account balance, in which case you go in for a statistical sampling methodology. So here there was a company, the company processed around 5,000 sale orders during the year, and in prior years the deviation for credit approval was up to 2%, and the auditor decided that a tolerable rate of deviation of 5% will be acceptable. So when he did the testing for say 80 samples, 3 orders for 3 points, which constituted 3.75%, lacked approved credit limit. So because this 3.75 is well within the tolerable rate of 5%, we are saying that it is acceptable, the deviation is acceptable, and we have continued with whatever testing we have done, and we have not increased any of our sample size. So here it is a different scenario where 4 errors were noted out of 60 samples, where the tolerable misstatement was 5%, but it ended up to be 6.5% post the testing. So as an auditor, we need to evaluate the results of the sample and whether we need to increase our sample size to cover that difference in the error rate, because it is not within our permissible or tolerable limit. So here there were 60 vendor invoices which were selected, for which for 2 vendor invoices the management failed to provide alternate documentation. So what happens in that case? So definitely it depends on what is the value of those invoices which you are talking about, and if it is not within our tolerable limit, it becomes a misstatement, and we have to increase, as I said, our sample size, because for a couple of invoices where we have not received the information that is missing, and we cannot just close that saying doing and all replacing the sample and doing a different sample because we didn't get the information. That is not the right way to address or close this particular exception. So here the auditor tested 40 purchase transactions. All 40 items were properly authorized and auditor concluded that the control was effective. At the time of controls, everything was fine. But when you did the substantive, there were some unauthorized vendor payments. So that case where you identified that your control was effective and you ended up testing lower samples, but the scenario turned out to be different where during substantive you found out there are a lot of unauthorized payments. Definitely you have to increase your sample size for the substantive procedures, because there, although your control was passed, in the substantive you are identifying exceptions. And you cannot say my control has passed, I have tested 40 and it was effective. So even if I'm going to have exceptions in substantive, I can live with saying that controls are effective and I can close with the exceptions. That cannot be the scenario. So here 50 purchase transactions were tested, whether they are properly authorized. So out of this 50, 7 deviations were identified where purchase orders were approved by officials below the authorized level. So here it is a clean deviation in your tolerable rate, where your deviation rate was 5%, but this has gone to 14%. So in that case, definitely we need to expand the sample size to include additional transactions, say from other, if there are, it is a manufacturing pharmaceutical company, so there are other locations, we select samples from other locations and also ensure that there are no further deviations, and conclude that whatever we had identified, those 7 deviations, because of which we have increased our sample size, and we have concluded that we have not identified any further deviations beyond that. Of course, for the 7, we should ask the management to look at the reason why there was a difference and what was the reason for it being more than my tolerable level. Whether there were alternate controls kept by the management from their end to see how they are tracking, if at all they had identified the difference like us. So here the company had more than 25,000 invoices in a year, and the audit team selected invoices manually from the first quarter only, believing it to be a representative. However, the quality reviewer observed that this introduced a selection bias because there was seasonal sales pattern which affected the pricing and discount. So obviously, so in that case, you cannot just cover your sample cannot be just picked from the first quarter, because you have seasonal fluctuations and your pricing and discounts are getting impacted. So you have to cover these to eliminate your a selection bias. So you have to select invoices covering all 4 quarters, and also from, if there are different branches, from various branches and customer categories also, so that it is a proper representative of the total population. So here we are verifying the purchases where the total population is 12,000 purchase entries, ranging from routine supplies to large capital procurement. The audit team considered testing 25 randomly selected invoices, all from a single plant location. So again, this is where we should use stratification, because it is spread across, and if there are many locations, you cannot just cover one location alone. So you stratify the population, like whether it is high value, low value, medium value, and then how many invoices you need to test, and whether it is within the tolerable misstatement, and what is the type of sampling that you are going to use for selecting the samples and testing. So at least the outcome of this is 90% of the purchase value was selected and tested, which is a fair representation of the total population, because you just out of 12,000 purchases, selecting 25 invoices randomly for a single plant location will anyway not support your conclusion that you have tested sufficient sufficient samples. So with this, I think we are done. Pretty straightforward, small auditing standards. So what I thought was, instead of brushing through the theory, if we give it through a example, it will be easier for us to actually relate and see what we need to do. So any questions? Otherwise we'll else we can break for lunch. Thanks for your patient listening.
So I would like to call our speaker, CA Eujiction sir. Please come on the stage. So he's a director. He's a director in the audit and assurance practice of Deloitte in Chennai, with over 10 years of experience providing audit and technical accounting services to domestic and multinational clients. So he is a chartered accountant as well as company secretary. So he's having total 10 years of experience and having multiple experience in multiple sectors, which includes software, healthcare, automotive, shipping, manufacturing, and consumer marketing. Handling large audits and mid-sized companies under multiple financial reporting framework like IFRS, USGAAP. So I would like to hand over this session to you, sir. Thank you. Okay, before this, I would like to call Manikandan ji. Please come and present the memento to him. Thank you. So, sir, handing over the session to you. Thank you.
Yeah, I'll probably come down so that it is easier to speak. Yeah, so am I audible? Yeah, so this session will be on related parties, and there's another session which will be there on using the work of other auditors. So just a quick introduction. So I am Eujiction. So my name might sound a little complex. You can call me Yuji. And I'm with the audit practice of Deloitte as a director. And yeah, so and we'll quickly jump into the topic already they have been introducing. And so this in continuance to our sessions which have been happening on auditing standards. So this is more on the related party bit. So here we'll mostly be covering the auditing aspects. And this will not be a session which is focused on accounting. And while we will try and cover the overall, because there are a lot of the ambit of related party is quite large. So there are multiple regulations, there are multiple guidances, there are multiple requirements which are there when it comes to related party. So what we'll do is we'll try to cover a brief on all the regulations which are there currently, and then what are the relevant auditing aspects which we need to, as an auditor, need to take care of when it comes to a related party. Yeah, so moving on. So before we get into the topic, just to get align ourselves on understanding. So why do you think there is a requirement for a related party, a separate standard for related party, and why is it considered to be a little different from other standards, different from any other transaction? Yeah, so there's a element of risk, and there is the transaction should be at arm's length, right? So don't you think a transaction with an unrelated party that also needs to be at arm's length, right? So why are we saying so what differentiates a transaction with a related party from a transaction with an unrelated party? Yeah, there's a subjective element. Any other answers? Emotional quotient will be more. Yeah, any other answer? Yeah, so mostly you've covered it. So when it comes to a related party, so the transaction, whenever it comes to a related party, the risk that it can happen at a price which is not at arm's length is always there, because when I transact with a person who is related to me, I might sell a particular good at a lower price. Because of that, there could be some investors or shareholders who might get prejudiced. So because the directors are running your company, and if I do a sale to a director, or I give a loan to a director, and if I give a loan at a 0% interest rate, right? So that will be prejudicial to the interests of the other shareholders of the company. So that is the reason why related party is always given focus to when it comes to a transaction between a normal party and considering a related party. And next is how do I identify related parties, and how do I define the terms? Who are related parties? The ambit is very large, right? So which guidance do I go to, and what are the guidances available? Are they all aligned? Are there different interpretations? Companies Act, SEBI, anything else? Income Tax Act, anything else? Yeah, so when it comes to as you all said, the Companies Act, and there is a accounting standard which has a definition of it, related parties, and there is this SEBI related guidance, which LODR, which comes through as, and it gives a set of guidelines for related parties. No, it's only for listed companies, and for list. Yeah, so it is, so so there are, so SEBI has, LODR is basically the name of the regulation, and LODR has a set of guidelines, and those are applicable only for a listed company, right? So now when it, so when we have three different regulations, right? So from an auditing standard perspective, does it have a separate new definition, or is it covered based on the three already? It is covered in already three. So what do I do? So do I have to meet all the three if there's a difference in the term, right? So if for instance, if LODR has a larger term, it includes the promoters as well. So do I, when it comes to an auditing standard, should I how will I like define my related party threshold? So will I apply it for everyone, or will I apply it for only as per Companies Act? It's more stringent. Okay. Does it have a separate definition in a definition or threshold when it comes to auditing standard? How many are saying yes? Can you have a raise of hands? As per the auditing standard, is there a separate definition or a threshold saying these are the list of related parties which are required to be covered? There is no right or wrong answer to this. So how many are saying yes? Yeah, how many are saying no? Yeah, so yeah, as I said, so when it comes to the auditing standard defines a related party. It basically says anyone, so who is, again, it refers back. So what it says is, what is there as per your accounting framework which the company is following, and if the company does not follow an accounting framework, then it gives a definition. All right, so the accounting framework which generally a company follows would be accounting standards or Ind AS as applicable to the particular company. And when it's not under this, then it gives the threshold, which is very straightforward, which basically says a company, it's companies in which it has control, probably your subsidiaries, and the companies which has significant influence, and similar definition for whatever is above, right? So companies which is a holding company of me, or some company which has 20%, more than 20% influence over me. So that is there in Companies Act. So this is basically in your standard. So what it says is, so there is a if there is an accounting framework, right? So on all your normal accounting, if you are following the accounting standards, if for a audit of a company, generally for all companies you follow an accounting standard, right? So if you're not auditing a company, if there is a LLP, or if there is a different kind of organization where you are auditing, so in that scenario where accounting standards is not applicable, then there is a definition which is given in the related party, so that it covers all the framework even in a scenario where the normal accounting standards is not applicable. But in a general sense, the company, it follows the Indian accounting standards when it comes to the auditing standards. But however, having said that, it also mentions if there are any transactions which are outside the normal course of business, it needs to get covered, and if it is a transaction with a related party. So it is always pertinent to note that all the other three, while from a compliance perspective and from other laws and regulations and risk assessment and all the other standards, it anyway covers that you will need to comply with the rules. So all the three regulations will apply equally, and then you will need to be very careful on whatever the related party and how we audit the related party, right? So, and next is, how do we identify transactions with the related party? So just a quick example, just to align ourselves on which are the ones which are related parties to a particular company. Let's say, take example of this group. All right, so this group has the reporting entity, which is the entity which we are auditing, and it has a list of upstream entities and a list of downstream entities. right? So when it comes to the downstream entities, so the ones which are colored in blue, so those are associate companies, and the ones which are not colored, which are in white, are subsidiary companies. So one is in gray is a joint venture, and whatever on the top of it, holding company, promoter, employee, director, all right? So those are the relevant shareholdings of the respective person. So now, is entity A related party to the company? So entity A, reporting entity, I audit a company. That company has 22% stake in entity A. So now, does entity A, in your assessment, is it a related party or not? So how many are saying yes? Yeah, how many are saying no? Yeah, so it is a related party. Now coming to the next entity, which is entity J. Company has 52%, but then it is a joint venture. So is it a related party? Yeah, yes. Okay. So and next, moving on. So the company, the promoter who has 10%. Right. So does promoter has 10% holding in a particular, in the company which we audit, right? So is it a related party? It's a related party. How many are saying no? How many are saying no? No one saying no. Everyone saying yes. How many are saying yes? Okay, most of us. Yeah. So next is employee, right? Who has yeah.
Good afternoon all. Very sorry to interrupt you all. We are from SICASA, Students Managing Committee members. Myself, Reshma Saravanan, Joint Secretary of SICASA.
Sai Divyesh, PR Head, Public Relations.
So we may not take much of your time. It is for the national conference that is going to be conducted for the students next week in Chennai, November 15th and 16th. Since many of you are practicing chartered accountants, it would be a great opportunity for us to connect with you and ask your permission to send the students for this national conference. The conference is named as RE. So in Tamil, RE means deeper ocean, where the tagline is wisdom of knowledge, waves of wisdom, and pearls of knowledge. So we have divided this conference into two parts: knowledge session and wisdom session. Knowledge session comprises of 4 compartments, which means first, auditing related standards and intricacies. Here in Chennai, we all know that construction department is seeing a very huge hike in the recent years. So relating to that, we have construction audit, which for which the students have practical exposures. Also, the second portion of this knowledge session is contemporary session. Contemporary relates to current affairs of the country, repo rates, then cryptocurrencies, all of these. And also the third one is moot court. Moot court is, I guess many of us would have handled litigations where we would see live demonstrations of court scenario. A judge along with the 2 members, one defending the case and one is against the case. So for our students, many of us would have not encountered litigations. For them to experience the court scenario, we are bringing a live demonstration of court scenarios. These cases are basically from GST and income tax, where these case would have been handled earlier and judgments for the same have also given. The fourth is the hackathon.
Coming to the hackathon part, are you everybody comfortable in Tamil? So I can make it easy. Yeah, okay. Hackathon என்னன்னா பேசிக்காக சிஏ ஸ்டூடெண்ட்ஸ்க்கு இப்போது எல்லாருமே ப்ராக்டிசிங் சார்ட்டர்ட் அக்கௌண்டன்ஸ் அப்படின்றதுனால உங்களோட ஃபர்ம்ஸில் வந்து ரிப்பிட்டேட்டிவ், ஏன்னா நானும் ஆர்டிக்கல் அசிஸ்டன்ட் தான், ஸோ ரிப்பிட்டேட்டிவ் டாஸ்க்ஸ் இருக்கும். நீங்கள் வந்து சில விஷயத்தெல்லாம் மேனுவலாக பண்ண வேண்டியது இருக்கும். அது எல்லாத்தையும் ஆட்டோமேட் பண்ணுற மாதிரி ஆர்டிக்கல் ஸ்டூடெண்ட்ஸ் who are coming and presenting the paper, like research paper, in that they will solve a real problem on technology, using technology and AI, so that அந்த ஆர்டிகல்ஸ் வந்து லைக் நீங்கள் ஃபேர்மில் வந்து நீங்கள் அதை ஆட்டோமேட் பண்ணிக்கலாம். அங்கே வர ஆர்டிகல்ஸ் வந்து உங்களுக்கு சில இதெல்லாம் பண்ணி கொடுத்து உங்களுக்கு பண்ணுவாங்க. அது ஒன்று. அண்ட் இது மோர் ஆஃப் ஸ்டூடெண்ட்ஸ் ரிலேட்டட் தான். ஏன்னா ஆர்டிகல்ஸ் போகிறவங்க அவங்களுக்கு யூஸ்ஃபுல்லாக இருக்கணும், ஃபர்ம்ஸ்க்கும் யூஸ்ஃபுல்லாக இருக்கணும், அவங்களோட நாலேஜ்க்கும் யூஸ்ஃபுல்லாக இருக்கணுன்றதுக்காக இந்த கான்ஃபரன்ஸ் நடத்துகிறோம். அதை தாண்டி நாலேஜ் இந்த டெக்னிக்கல் செஷன்ஸ் அண்ட் ஹேக்கத்தானை தாண்டி, ஏன்னா ஹேக்கத்தான் ஹேப்பனிங் ஃபர்ஸ்ட் டைம் இந்த நேஷ்னல் லெவல் சென்னையில் தான் நடக்குது ஃபார் தி சிஏ ஸ்டூடெண்ட்ஸ். அண்ட் நான் டெக்னிக்கல் செஷன்ஸ், தட் இஸ் மோட்டிவேஷனல் செஷன்ஸ். அதில் போன வாட்டி தட் இஸ் வியூகம் அப்படின்னு போன வாட்டி ஒன்று இருந்துச்சு நேஷ்னல் கான்ஃபரன்ஸ். அதில் ஃப்ளிப்கார்ட்டோட சிஎஃப்ஓ அண்ட் பேடிஎம்மோட ஃபினான்ஸ் கண்ட்ரோலர் அண்ட் அமகாஜா பேட்டரிஸோட சிஎஃப்ஓ அவங்களாம் இன்வைட் பண்ணியிருந்தோம் டு இன்ட்ராக்ட் வித் த ஸ்டூடெண்ட்ஸ். ஸோ தே கெயின் மோர் நாலேஜ் ஆன் தட் இன் த வேர்ல்ட் ஆஃப் ஃபினான்ஸ் அண்ட் பிஸ்னஸ். இந்த வாட்டி நாங்கள் வந்து வி ஆர் அப்ரோச்சிங் சிஎஃப்ஓஸ் அண்ட் சிஇஓஸ். த நேம்ஸ் ஆர் நாட் கன்ஃபார்ம்ட் yet. வி ஆர் அப்ரோச்சிங் ஸ்டில் yet. அண்ட் அதை தாண்டி கண்டிப்பாக வருவாங்க. ஹை நெட்வொர்க் சிஎஃப்ஓஸ் வில் பி கம்மிங். அண்ட் ராம்ராஜ் காட்டன் தெரியுமா, எல்லாருக்கும் தெரிஞ்சிருக்கும், புட்டிக்கோ கட்டிக்கோ அந்த அவங்களோட அந்த ஃபவுண்டர் வராங்க டு அட்ரஸ் த ஸ்டூடெண்ட்ஸ். ஸோ இதெல்லாம் வந்து ஸ்டூடெண்ட்ஸ்க்கு என்கரேஜிங்காக பண்ணுறதுக்காக ஐசிஐ வித் போர்ட் ஆஃப் ஸ்டடீஸ் பண்ணுறாங்க. வி ஆர் ஹோஸ்டிங் இட். சிகாசா, சதர்ன் இந்தியா சார்ட்டர்ட் அக்கௌண்டன்ட் ஸ்டூடெண்ட்ஸ் அசோசியேஷன் வித் SIRC ஆஃப் ICAI ஹோஸ்டிங் இட். ஸோ நீங்கள் எல்லாரும் உங்களோட ஸ்டூடெண்ட்ஸ் லைக் உங்கள் ஆர்டிகல்ஸ் அண்ட் உங்களுக்கு தெரிஞ்சவங்க கூட ஷேர் பண்ணுங்கள், அட்டென்ட் பண்ண சொல்லுங்கள். த 2 days இட் வில் பி ஹேப்பனிங் ஆன் 2 days, தட் இஸ் 15th and 16th. 2 daysக்கு லஞ்ச் அண்ட் ரெஃப்ரெஷ்மெண்ட்ஸ் எல்லாத்தையும் கவர் பண்ணி 500 ஸ்டூடெண்ட் கிட்டோட கவர் பண்ணி உங்களுக்கு 500 rupees சார்ஜஸ் per student. ICAI will be burning upon 2,000 rupees per student and we recover only 500 rupees. So total charge to 2,500. ஸோ கண்டிப்பாக என்கரேஜ் பண்ணி சப்போர்ட் பண்ணி நீங்களும் ஆர்டிகல்ஸ் கிட்ட சொல்லுங்கள். முடிஞ்சால் ஃபர்ம் சைடுலேருந்து நீங்கள் கொஞ்சம் ஸ்பான்சர் பண்ணி அனுப்பிச்சி வைங்க. நாங்கள் அதுக்கான டீட்டெயில்ஸ் அண்ட் ப்ரௌச்சர் அண்ட் லிங்க்ஸ் எல்லாத்தையும். ஸோ தேங்க்யூ எவ்ரி ஒன். தேங்க்யூ. யா, தேங்க்யூ சார்.
Yeah, continuing the session. So, going back. So the first two we said it is a related party, right? So this entity A and entity J. So someone come and say why it's a related party. Okay, because it's a joint venture associate, it's a related party. That's very straightforward. Next is a promoter, where we say 10% is held by the promoter, right? So many said this is covered as a related party, but Companies Act, it only says entity which has a significant influence, right? So does the promoter have a significant influence? Is a party too? If there is a shareholder level transaction, so if there is an approval which needs to happen, right? So will he be able to exercise the approval if with a 10% control? He'll be able to influence the decisions. Yeah, you're right. So because of that, he will be a related party. And next is employee who holds 3.6%. Probably he would have gotten ESOPs, which would have been converted to share capital. So he holds 3.6% in the company. Is he a related party? Yeah, it's a single employee. Yeah. So is he covered as a key managerial personnel? Yeah, so we are saying top level, right? So what is the top level? How do I define it? So he's only a shareholder. He has shares. He has 3.6% shares in the company. So how many of us are saying yes, he is a related party because he has? Okay, so does everyone agree with the answer? So he's saying if it's, so let's say they give only one employee, right? And he is and he has more than 3.6%, and he is not there in the board of a company, right? So he's not related to any person in the board. Let's say he's a head of operations of the company, and he has 3.6%. Sorry, if he has an influence, then he'll be a related party. Any other answers? How many of you are saying no? Yeah, how many for yes? If he is able to influence. So yeah, so when it comes to shareholding, which is less than 20%, and the person is not a key managerial personnel, then it will not apply. And for us to see whether it is he's a key managerial personnel or not, it is only not only the designation, it is not only yes where he's the CEO or CFO of the company, but rather as he had mentioned, so we should also see whether he is able to influence the decisions of the company in substance and in form, whether he is able to take if he takes a decision whether it is binding on the company, whether he is able to affect the financial and operating functions of the company. All right. So next is director who holds 1.8%. So he's a related party, he's a KMP, right? So next is coming to this company. So what we do, we have a reporting entity which has 22%, and that company which is an associate, and that company has another associate which in which it has 25%. All right. So is this a related party? It's a related party. Why no? Company doesn't have a direct connection, but it's connected. No, it has 20%. It has it is anyway in the entire group, right? Okay. Any other answer? So how many of us are saying yes? How many of us are saying no? How many maybe? The rest, right? So yeah, so we will come to it. And next is a scenario, right? So where there is a subsidiary of mine. So I have 60% in entity S, and there is an entity R where he holds entity S holds 25% in entity R, right? So is this a related party? No. Okay, why no? Yeah, 60. 60 of 25. You're saying it's less than 20%, so it's not. Any other answers? Yes. How many yes? Yeah, there's one yes. How many are saying no? Yeah. And so going back to the previous question, right? So in that scenario, so it is only 22% of 25%, right? It's only 4 or 5%. So how many are saying no for that? Always no. Okay. Okay. So basically, if you go back to the standards, what it says is if I have a significant influence in a particular company, then it's a related party. And when I look at the scenario of R, right, the one into the so this company, so I will not directly multiply the percentages. All right. So from a holding perspective, so when it comes to a consolidation, probably when 25% gets consolidated, 25% will get multiplied when it's when they're doing equity pickup kind of an accounting. But when I look at a control, right? So I am able to control entity S, right? So if I am able to control entity S, whatever I tell them, he will be able to follow. And if entity S has a significant influence in another company, he will be able to influence the decisions of that company, right? So the standard says that will be considered as a related party. But whereas in the previous scenario, so the first when reporting entity has a 20% investment in A, he has an influence on A, but he will not be able to control A. All right. So when I go further down the chain or further down the group structure, so then again, I'll be able to influence. I cannot control him. I cannot go and tell him that if all the decisions I cannot take part in and try to influence this decision. So entity Q will not be a related party, but then entity R would be a related party. All right. Yeah. So any questions? Yeah. So we'll progress. Yeah. So generally, what are the transactions which can generally happen with our related party? Purchase, sales, loans given, taken, advances, and rental income and all of that. Okay. And is salary paid to a director also a related party? It's a related party transaction? Yeah, it is. And is let's say I accrue for gratuity. I don't pay him. Right. So I accrue for gratuity for a CEO. So will that also be a related party transaction? Yeah. Okay, it's not identified, so it's not a related party transaction. So how many are saying have different opinion? How many are saying it's not covered? How many are saying it's covered? Yeah. So any other examples? Okay, so that you're saying gratuity will form part of the related party transactions, right? Yeah, we'll come to it. Any other examples? So any transaction with a related party is basically a related party transaction, be it something which happens for a consideration, not for a consideration, or whether cash is exchanged, cash is not exchanged, right? Be it dividend, be it sale, be it loan which is given, being loan which is given without interest. I only transfer a particular property, plant, and machinery to another person without any consideration. That is also a related party transaction. So any transaction which happens is a related party transaction. And taking analogy, a group gratuity scheme where the person where the CEO or CFO is enrolled. So that would also be a transaction, related party transaction by nature. But having said that, I would not be able to attribute a particular amount to that particular employee. So generally what happens is when a disclosure is given, from a disclosure perspective, there is a footnote which is given saying that in case of group gratuity scheme, this is included, and that certain the key managerial personnel are eligible for group gratuity scheme, and then since it is done as a whole, this is not being separately presented. But any transaction is is covered under a related party transaction. So these are some examples: loan to director, purchase of goods, and guest house accommodation, investment in associate, dividend, and all of that. So out of this, to your mind, is there anything where we should be more worried about when it comes to all these, taking these as examples? Are there one or two cases where directly when you look at it, it looks like a problem, and then you would want to further question it? Loans to director without interest, right? So any related, from a standard perspective, what it says is any related party, if there is going to be a transaction, then I would need to look at it, and I'll need to assess the risk, whether because the risk assessment and risk of material statement is considered to be higher by default when it comes to a related party transaction. And while we have identified all the related party transactions, there could be certain set of related party transactions where the consideration is not adequate, or where it is not happening at arm's length, right? So how do you do it? So if I'm give a loan, right? So what will be the arm's length for a loan transaction? Yeah, so the interest rate, right? So I'm giving him money, I'm not earning any interest. So the company is at it's not, the transaction is now not happening at the arm's length. So if it has to happen at arm's length, I'll see what is the market rate, and if I am getting it at the market rate, then it is okay. All right. So if it is, so it depends. So as you so if it is covered as part of CTC, and if he's, yeah, so let's say bank rate is 8% and he is getting a 2%. So how many of us are saying this is okay? As an auditor, I will not be questioning it, because this is as part of his employment contract. Yeah, if let's say it's not a lending company, it's fine. Yeah, how many are saying it's perquisite? Let's say it gets taxed. The company pays tax. Let's say company pays tax for the difference. This is more from a auditing perspective. Will you go and ask them? So let's say everything else is compliant. Yeah, I've seen everything is compliant. Tax is compliant. Everything else is compliant. Now what's your answer? It's okay. Yeah. So how many are saying it's not okay? Yeah. So why is that? Loan to director with a interest of 2% when the market rate is 8%. It's prejudicial into the interest of the company. Yeah. Understood. Yeah, so there are certain compliance from a compliance perspective, as everyone said, there is from a Companies Act, there's a section 186 which prohibits a loan without an interest. But then, so it is not, I mean, if there is a loan which is given to a key managerial person or a director directly gets covered under directors or companies in which directors are interested would get covered under section 186. But having said that, there is also a catch to it. So when I'm not a lending company, but I have a practice for if I've in all the offer letters of all the employees, all right. So I have a clause saying 2%. I will grant you a loan at 2% when the market rate is 8%. Then it's still fine, right? Because I'm following a practice which I do for all the other employees. Yeah, it should be for the entity throughout, and it should apply to all the employees. So if you are trying to demarcate your compensation to a director separately, and if you are trying to give a loan at a percentage at a lower of the market rate, then that is not allowed. That is a non-compliance of the section, or else it is allowed. And there are reporting consequences. There are Caro related questions and all of that. But from a pure, so generally this transaction needs to, when such a transaction happens, it needs to trigger a sense to us to say that we need to focus on this transaction, and then we will need to try and look at it. And there could be a simple transaction, right? So let's say a company, I own a particular brand, right? So let's say I run a pharma chain, right? So and I run a particular company, and there's another company which is related to me. So my brother runs another company, so he uses the same logo as I am using, right? So is this a related party transaction? So he's not paying anything to me. It's a related party transaction. So how many are saying, so he's not paying anything to me, right? He's not paying, he's using out at his own will. Yeah. So as I earlier said, so a transaction need not be a defined for a defined consideration. So and any transaction which happens will get covered under related party. So this will get covered under related party. It is basically you are lending your intellectual property to another related party without getting a consideration. So it's not at arm's length, right? So that's basically on the transactions and the consideration which needs to be there. And this is purely from the standard. So the standard gives the following set of considerations. So one is the responsibility. When it's related party transactions, your focus should be higher from a normal transaction. And next is identify the risk of material misstatement. So what I do is when I audit a normal transaction, right, normal sale, if I consider my risk assessment to be a particular threshold, let's say it's lower, and then I select 10 samples, but when it comes to a related party, my rigor should be a little higher, and I should understand the exact nature of the transaction, and then my risk of material misstatement has to be higher. And next is identification of undisclosed related parties. So how do we do that? Let's say you go to a company, we go to a company and audit the company, and the company says, I don't have any related party transaction, right? So how do I identify transactions which are not disclosed? Sorry? Okay. Yeah. So I'll look at the characters declaration, and then I'll try and see. I will see whether a transaction has happened to that party. Now, how will that? So director's declaration will only have the names, right? So company is saying, I don't have a transaction with any related party. So in your financials, they're not giving any related party transactions. So any other examples? How do I go and check? Yeah, I'll see the minutes of the meeting to see whether there's any related party transaction. Yeah. Understood. So these are certain checks which I can do, certain procedures we can do. There is a separate list of illustrative procedures which generally we do, so that we can come to it later. So next is understanding the purpose. So this is very important because depending on their nature is how and you can assess whether it is is it at arm's length or not. So there can be a transaction which normally under the contract it's saying it's a normal sales transaction. So let's say I make a sale of good to a related party of mine, and then again I purchase it back from him through another agreement, right? So let's say, and the company says, so I make a sale at 100. So let's say I purchase from a related party and I sell it back. So let's say the purchase value is 100, I sell it back at 120, right? So it's very important to understand why does they have all contracts, they have purchase order, they have the goods have actually moved, it has come on a particular date, it has they've followed all the Inco terms, while everything is right. So the main intention of the standard is that you should go understand in detail, you should inquire and the nature and purpose of the particular transaction, and you should assess whether in substance it is a transaction which has happened at arm's length or not. And to identifying a transaction which is not in the normal course of business. Let's say in a particular year, but there is a large other income, right? So which the company has recorded. When you go and inquire, the company basically says, I did a one-time sale of machinery to my related party. So it resulted in a very huge income. So this is a transaction which happens outside the course of business, right? So those are certain transactions which we should be very mindful of, and as usual the professional skepticism, and the last two are on disclosures and how reliable fair and opinion. So if there are disclosures, if there are other compliance related issues, or if there's a transaction which is not happened at arm's length, and then you're trying to get an arm's length assessment, and then you see that the difference is not tying up, then finally you need to see what is the implication on an audit opinion standpoint. So what is a transaction which happens? They generate code, okay. Okay. Yeah, so generally what we do is, so we see, we bifurcate into two things. One is whether the company is the subsidiary or the holding. So whether it's a foreign transaction or a local transaction. Well, if it is a foreign transactions, it will be covered as per the transfer pricing study which they do, and as part of the transfer pricing study, so they will need to identify. So there are multiple methods, right? So they'll either use a transaction multiple net margin method or a comparable company method. So they'll try and see similar transactions which have happened in other companies, and then they'll try and benchmark it. So when it comes to so this is in case of foreign company, because it's already readily available. If there is a local subsidiary, your procedure does not change, but the only thing is reports are not readily available. So it depends on the quantum. So if you have been auditing the company and Correct. No, that's what I'm saying. So from a procedure perspective, your procedure does not change. So if it is covered under transfer pricing, and if they have gotten a transfer pricing study done, and it is as per the arm's length assessment which they have done, you can rely on that, and then you can test that whether that is being done properly or not. So in instances where this is not getting covered through a transfer pricing study, so then you will still do the process. So in that process, first you will bifurcate the transactions into two. Right. So first is whether it is happening in the ordinary course of business, whether it has happened you have similar precedences in the past. And second is how much is the profit margin which the other company earns, whether it is in line with the markets. And overall, if you are okay with the process and then the margins are sufficient, you will continue, you will not probe into details. But there are other instances where we've seen company having a transaction with another related party, mostly in case of listed companies. Recent there are this industry norms and all where they specify there is even if it's a related party and if it crosses a certain threshold, while giving an approval to the board itself, they need to see management as a responsibility to say how is it at arm's length, right? So management, when they do an assessment of how it is at arm's length, they may engage a separate valuer, or they might engage a separate consultant to try and see. So at the end, what they are going to do is they are either going to compare multiple different companies, or they are going to see whether how much is the net margin which is available, whether it is normal as per the general market thresholds. So it depends on the nature of transaction. If it is going to be very material, really large to the size of your company, you don't have sufficient evidence, it is the management needs to involve an expert and then try and do a assessment, or we will, or else if we are able to conclude and the transaction is in the normal course of business, we will continue with it. Right, so these are certain procedures which are indicator procedures which can be done. So one is, as someone had mentioned, the minutes can be reviewed, right? The board of directors minutes and the shareholders minutes, they could have discussed the particular transaction, but then the management is saying that's not a related party. So you will probe into that more, and then you will discuss on that. And second is review of income tax records. From a transfer pricing perspective, that has a different set of rules, a different set of associated person. There's a different terminology, and that has a ambit which is even larger at times. So what you do is you take an entire list of parties which are covered as per their transfer pricing report and try and map it back to whatever is whatever we have considered as a related party transaction. So next is internal audit reports, and where they could have covered some of the related party transactions. So I will go and then look into it and then try and see whether those needs to be covered as part of my report as well. And entities investment, if I have made an investment, it will lie in my investment schedule, and in as a investment register of the company, I'll go and see whether they have invested in a company more than 20%, whether it's actually a related party or not. And the others are agreements with key managerial personnel, agreements with those charged with governance, and scrutiny of general ledgers is basically I will take a list of parties. So let's say from the MBP one, I'll go back to the ledgers and see whether those parties, any transactions exist in the current year. And ROC filings, MBP 1, DR8, as he rightly mentioned, MBP 1 is the list of parties which the directors are interested. I will take that as a start point and then go and check whether there are transactions with those parties or not. And MCA database for directors. So that's another procedure. So next is how do I see whether once I've identified parties, now I know 10 parties are related parties to me, right? So how do I know whether 10 parties this is the complete list of transactions? From a procedure perspective, as an auditor, what will be the set of procedures which we can do to ensure that the list is complete? So I mean the list of transactions are complete. So let's say I have done I'm a company, so I transact with 10 related parties. I initially had a balance of 10 rupees, and at the end I have a balance of 500 which I should pay to another party. So basically the difference between these two, those are the ones which will get covered as a related party, right? So how will I be able to know? So what I can do is I will do a roll forward. I'll see what is the opening balance, and I'll see what is the closing balance, and I will roll forward the transactions. What are the sales made? What is the collection received? What is the other? Yeah, so I will do the entire roll forward from take the entire transaction dump, collate it into opening balance, and multiple transactions happen during the year, and then come to arrive at a closing balance, and that I try to map it back again to the financial statements. So that is one procedure. Thereby we will know at least whatever is recorded in the books of accounts, that is appearing in my that is covered as a related party or not. So next is what do I do from an existence perspective? So I mean, like, the amount is correct. What other procedures can I do? So when you're auditing a bank, cash and bank balance, what do I do? So when I confirmations, right? So I will get a confirmation from the related party. The other person needs to confirm, and then I will get back. And this needs to be independent confirmation because because or else there is a chance that it would get influenced. So what we generally, as a practice, it's better to send out confirmation without the amount, so that the other person can send the amount and the total list of transactions, because with the amount at times it tends to confirm the same confirmation. So always a negative confirmation is gives more evidence when it comes to existence. and the other one is reviewing the business rationale is for a existence perspective. And obviously the written representations from the management. But written representations is the last resort. But we having said that, the regulators are very specific that there should be evidence that you have done primary testing, and then you have also covered it through a written representation. So the primary procedures is required irrespective of whether we are getting a written representation or not. It depends. So exhaustive might not be possible. So materiality can be applied. So as it was discussed in the previous topic, right, when on sampling. So sampling applies to all the transactions. So related party transactions. So there are companies where it will run to hundreds and crores of line items. So without sampling, I will not be able to test it. So the testing methodology is the same, right? You will test samples, you will test whatever documents, but the nature of transactions is what you need to be very worried about. If it's a sale transaction, you'll again going to test as part of covering the existence of sales. But additionally, when you are doing a roll forward, there are 10 transactions which has happened in a particular company. So let's say there's a sale, there's a purchase, there's a let's say there is a loan which has been given to that particular party, there is interest which has been received. So when I collate all the 10 or 15 transactions made to a particular party, if there is a particular transaction which probably, let's say there is a sale and purchase for the same good, right? And or else there is a interest which is not being charged to a particular party. There is a loan which but an interest is not being charged. So these are the transactions where I need to focus more on. So the standard is not saying don't do a sampling. The standard says you have more focus and identify, correlate items and see where are the items where there are more risk, and you focus more on those items. Yeah. So moving on, and disclosures and compliances. So disclosures as as we already spoke on India's Companies Act, SEBI LODR are the disclosures, and from an arm's length perspective, I will see for transfer pricing in case of foreign companies and domestic companies, the pricing comparison or any other procedure which we generally do to test an arm's length. And this is broadly the from a summarization of the compliance requirements currently. So there is a INDAS 18, IAS 18 or INDAS 24 related disclosure requirement, where we in the standards we are required to disclose the entire set of related party transactions. And the other one is the Companies Act related compliance when it comes to a loan to a director or the related party transaction. And additionally, in case of listed companies, there are additional requirements wherein all the transactions with the related parties are to be approved by a audit committee, and there is additional shareholder approval if it crosses a certain threshold. And incremental to that, from a compliance perspective, there are additional focuses being brought in for related parties from a SEBI and listed companies perspective. So there are these NAFRA has released a list of as part of its interactive series has released a set of questions for the audit committee to ask in general what is the rigor which is given when it comes to a related party transaction. And also there are this industry norms which are being which is being effective from 1st of September. So in case of a listed company, what happens is, for when it goes for an approval to a audit committee and to a shareholder, there is a certain set of requirements which are given. So all those requirements, all that information needs to be there when the agenda is being circulated for approval of related party. Right. So, and from a quantitative and qualitative assessment needs to be done. Quantitative is basically the quantum of the material, whether it is really material to you from a entire financial statement standpoint. And qualitative, depending on the transaction, do you need to focus more on a particular transaction, whether it is with the key manager or does it lack arm's length, whether it is happening at arm's length or not. So those are the considerations which needs to be there when it comes to a later part transaction. Next, coming to there are certain instances where we should worry about. So for instance, when common indicators or red flags when it comes to related party transactions. So these are a certain list. For instance, if there is going to be unusual payment terms, right? So what could be an unusual payment term? How do I find out whether a payment term is unusual or not? Giving excess credit period, right? So I make a sale to a third party and I tell him, you pay me back within 30 days. But when I sell to a related party, I tell him, you pay me back in 1 year. So that is a unusual credit payment term. Next is significant transactions at the year end. So why is that a problem? Why will someone book at the year end? But he can do that during the year itself, right? Why can't he reverse it in May, or why can't he reverse it in June? Sorry? To achieve targets. Yeah, profit based incentive, that will change. Sorry? Yeah, to affect the financial results. So these are reasons why they will account it, while they will try to manipulate the profits. But why at the year end? They can do it even in September. They can do it in any other month, right? Yeah, generally. Yeah. So right. So general tendency, there is no. If he's very smart, he will do it in the mid of the period, so you will not find it out. So or else he will do record it at the year end. So generally, what happens is, in case of companies, if they do a proper book closure, they will not be able to backdate and then do entries. So there are certain things where we focus when it comes to transactions which are these are prone. So like in March, at the end of the month, they will post the entries for it. If I have a book closure, suddenly I have to close books. Mostly they will post it in the last day for them to try and inflate profits or try and inflate revenue and all of that. But it is not the only, they can do it in any other month, right? So yeah, so next is a circular transaction. So what is a circular transaction? What? Okay. So it's there. So basically circular transaction is a transaction, I mean, it doesn't have an actual substance, right? So I do a sale to a particular party, I purchase it back to the particular party from a related party. So why will I do that? But why will I need an inventory movement? Okay, inventory turnover ratio will. Okay, any other reason why someone would resort to this? To pass on tax credit. Okay, why will the tax credit be passed on for this? Because of this? Okay, sorry. Dividing the margins. Okay, so there could be any number of reasons. So there can be a scenario, it depends on company to company, because we've seen scenarios where a company, one of the company could be SEZ where it will not pay taxes. The other company could be in a different zone where they will try and push profits to the SEZ so that they don't pay profits. And there could be a reason where they need to inflate the sales because revenue could be a very key indicator to for the share price movements. Right. So in the what they'll do is they will record a sale and a purchase, and but actually goods would not have moved. Right. It will be in the same place. And there can be a scenario where your inventory, there could be a long aged inventory without any movement. So just to show a movement, they can record 2 transactions and then change your date so that your inventory comes in the lower aging bracket. Right. So these could be certain examples, and something which is different from market norms. Generally market, this is the percentage which I get, but this is at a different percentage. That could be a reason. And something which does not, this lacks a clear rationale. So that these are certain examples of transactions where once we look at it, we should probably look at it with a higher rigor, because there could be a problem with this particular transactions, and there could be a actual something more in detail where we need to spend more time to understand it in detail. Yeah. So so financial. So these are certain instances where based on history, we've seen that manipulation is being done. One is for manipulating the earnings at each quarter. they will record a particular transactions at a higher value or at a lower value. And the second is an asset tunneling. An asset tunneling is basically where a company sells or without even actually, let's say I have a fixed asset, I sell it to another company at a lower value, or let's say a share, I have a share investment in a particular company, I transfer it to another related party of mine for a lower consideration. So that could be asset handling. And the last one is on round tripping transactions, which again is more like a transaction which happens so the back and back, so like similar to a sales and purchase transaction. So that is on related parties. This is the broad overview. So this is what is covered. So there is another session which I will be covering on group audits as well. So first, any specific questions on related parties we will address before we move on to the next topic. Yeah. So any audit, right, despite being a certification or an audit or any other this thing, so you are supposed to give a report to that, right? If you as a stock auditor, you will give a certificate or you will give a report to, as part of your report, if that is there as part of your deliverable. So let's say your focus is on inventory. I certify the inventory and the fixed assets. This is maybe for a bill discounting arrangement where they go and tell you audit the total stock, and as part of that, if there is a item which you've noticed which will affect your report, then obviously you will see whatever modifications you'll do in your report. So your question is where it doesn't affect me, but then there is a transaction in the company, right? So there you can always issue a management letter. So management letter, not a management representation letter. There is also a concept of a management letter where I will tell the company that these are the issues with which I can address directly to the those charged with our governance, and then I can either generally as a communication we send it out through a mail, or we have a conversation with them saying that these are the transactions which we noted, where it can be a control lapse where I say this should have happened or this has happened, and you highlight it to them. Or if it's an actual fraud which has happened, you can have a separate you make it a point that the management letter will need to be communicated, and as the standard requires us to give a management letter as well. So if we have any improvements or if we have any, so that we can separately communicate and then give it. So if it covers, if you are, so if you are, ma'am, if you're issuing a certificate or yeah, so it depends on your deliverable. So if it's going to be an agreed upon procedure, right, where you are going to say I have done these procedures, and if it does not affect your procedure, then it don't make sense for me to refer to something which is not part of my engagement letter itself. So, and if you are similarly, if you're giving a certificate, there is a specific opinion or a conclusion where you will draw in your certificate. So there, it won't make sense for you to qualify something which is not even my deliverable, right? So in that scenario, what I do is I'll give a separate management letter. But if it affects your deliverable, then you will need to do a qualification. Yeah, so I'll probably progress to the next session. So, and then we will, again, we can come back for questions and related parties as well. Yeah, so this is on using the work of another auditor. So quickly going on. So when do I apply the standard? So in what scenarios this will be applied? Joint audits, right? So anything, any other scenario? Branch auditor. Okay. Okay. So you're saying joint audit is not covered? No. So we'll come to it. So in your, just give an intuitive answer whether it is covered, not covered. Not covered. Yeah. So any other example? Stock audit. Okay. Any other example? Staking of opening balances in case of change in auditor. Okay. Yeah. Any other example? So whatever you said, everything is auditing aspect of auditing, right? So where we will generally cover it as part of this standard or any other standard. So what this standard seeks to address, we will come to it in a minute. So we'll have 4 scenarios. We'll quickly see. So first is I audit a manufacturing company, and there's an internal audit is being performed by another auditor, right? So does this standard cover the? So this is the name of the standard using the work of another auditor, SA 600. So does this? Yeah. So it is no. So because the internal audit is covered by another standard, while that also needs to get covered as per auditing standard. This is a separate standard on using work of a internal auditor. So next is I audit another company, and tax audit done by another auditor. Is it how many for yes? Yeah, how many for no? Yeah. Okay, so the answer is no. So because what this standard seeks to address is basically I am doing an audit of a company, right? And I, as part of my audit, if a certain portion of my audit is being done by another auditor, then that portion of account balance is being covered by the other auditor. So he will be another auditor for me. So I will be the principal auditor. So that is basically the intent of the standard. And next is I have 5 branches. One branch is being audited by another auditor. So is this another audit? Is this covered? It is covered. How many are saying no? Okay, it is covered under the standard. And similarly, there are 2 subsidiaries, and the subsidiaries are audited by another auditor. Right? So is this covered or not covered? Covered. Yeah, we'll say it's covered. So and coming back to the earlier answers which you gave, right? So how many are saying a joint audit is covered under this? It's covered. Sorry, separate? Separate SA for separate. So how many are saying? Yeah, so joint audit, it is covered under the auditing standards, but not under this auditing standard. It is equally, if there are considerations for a joint auditor which needs to be applied, that is coming under a different SA 299 when it comes to joint auditors. And but this standard, it specifically applies only in cases where I use the work of another auditor. So let's say I am the principal auditor. I sign the balance sheet of a consolidated balance sheet of a company. And let's say 10% of revenue is earned by another company, a subsidiary company of mine, and that is being signed by another auditor. So he will be another auditor for the purpose of this standard, right? And so again, so stock audit which a person performs for bill discounting, right? So will that get covered as part of this? Yeah, stock audit is not something which we'll use when we are doing a audit, right? So audit to be, because so stock audit is something which is a separate report which the auditor provides to the banker and not even to the shareholders of the company. So that will not get covered under this standard. Yeah. So next is what are the considerations which I generally have. So basically, so let's can someone, so going back to the previous examples. Yeah. Sorry, bank they appoint, sorry? Okay. No, this standard specifically covers, so let's say, yeah, so UDIN gets generated in any case, right? So even in the previous scenario, so if there was this tax audit, right? Tax audit, you generate a UDIN number for the same company, right? So the end result is, so you basically audit a company. So let's say a company has 5 subsidiaries. You give the console opinion of the parent company, right? So 5 companies need not be audited by you. Correct. So it can be audited by another separate independent auditor. So when an independent auditor audits these 5 companies, but then this financial statements of these companies is consolidated as part of the final opinion which you are giving. Right. So when that is the scenario, so I need to place reliance on the other auditor. So what I will do is I will send instructions to them, and I will say you report to me saying the numbers are okay. Right. So this is not a scenario where that auditor goes and signs on a tax audit report. I rely on this, or he gives some of a report for some other purpose and then I rely on it. I give a instruction to him saying, you give a report to me saying your numbers are okay, and I rely on the auditor's report. So that is basically, so this standard has a very limited coverage for specifically with respect to I am auditing a company and certain account balance or certain branches, certain subsidiaries are audited by another person by default because he's been the auditor for a very long time. So if I, from a group perspective, if I need to sign off, right? So if I have a coverage of 80%, whenever I am sufficient, I'm okay with 80%, or should I go and review his work? So that is basically what is covered under the standard. So yeah, so how will I determine which entities I cover? Basically, materiality would be a consideration, and there will be knowledge about the components. So there are 5 subsidiaries. What does this subsidiary actually do, right? So whether I need to focus on these 5 subsidiaries or not, that will be a consideration, and there will be this competence of the other auditor, right? Whether the other auditors who are involved. So let's say he's not even not a chartered accountant. He signs off and then gives the balance sheet. So and he's not sufficiently competent. So let's say it's a foreign subsidiary. There's no requirement for a chartered accountant to sign off, right? So then I'll need to evaluate his competence and this and risk of misstatement. So let's say in a particular subsidiary there is a one-off transaction. There's a huge loss, factory fire which has happened. Some 200 crores they have written off, right? So it is audited by another person, but consolidated financial statements, I am the person who's signing off, right? So that becomes very relevant for me to go and look at the balance sheet of the subsidiary companies as well. I'll review as part of, because I am signing the consolidated financial statements, and tomorrow I'll be held responsible for the if any transaction goes wrong in the subsidiary as well. So risk assessment, competence is something we spoke about, and finally how you get it coordinated with them. So what is the deliverable which you get, right? So what you can do is, so if there are five subsidiary auditors, and you can send out instructions saying that you give these on this particular dates. He will send back to you. He will report back to you, and using the report, you can also have a scheduled review. So let's say this in the scenario which I had explained, right? A fire in a factory. So your entire company's profit is 100 crores, but last year it was 300 crores. This year, because of the 200 crores of loss because of factory fire, your profits have come down by 200. So it's a very important item which you'll need to look at, right? So even though you're not the person who signed the subsidiary, you're signing the consolidated financial statements. So you will need to do additional work paper review. You'll need to additionally do an audit of that company, even though you're not an auditor. And as a parent auditor, as a consolidated balance sheet auditor, you are privy to all that information. So you will do that audit as well. So performance, additional procedures, whatever we spoke. And finally, reporting considerations. So let's say out of the 200 crores number, so when I looked at it, I come to know that out of the 200 crores, there is a very large insurance claim of 200 crores which has already been approved. So they should not have recorded a loss. But then the management is not agreeing to record an insurance claim, and this could be a very huge tax consequence, right? So re-reporting consequences, even though I'm not the auditor, from a console audit perspective, this could be very material, right? So those are very important considerations which I need to keep in mind. So current guidance, SA 600 is one standard which we are talk about. Apart from this, there is in case of listed companies, there is a SEBI circular which was issued in 2019, which is very relevant, which basically says that for your company, so your total asset, so let's say I audit a listed company, and that listed company has multiple subsidiaries. Let's say it has again 5 subsidiaries, and the total assets of the consolidated company, and total profits, and the total revenue. So 80% of the of these total assets, revenue, and PBT needs to be reviewed by me as the parent auditor, or else I cannot sign off on the balance sheet of the company. So this is an additional regulation which came in 2019, which we should be aware of. And then there is another standard which has come through, is on revised SA 600. NAFRA has given an exposure draft which is due to come in next, which is expected to come in next year. That is in 2026 April. And once that gets notified, so what happens is, even though there are multiple component auditors, the main risk of actually reporting on the entire balance sheet falls with the principal auditor. So I cannot go and say tomorrow that I have not audited this company, this is a subsidiary company of mine, And as a principal auditor, I will be responsible for whatever subsidiaries which are there in the company as well. So this is effective for international standards already. ISA 600, which is the equivalent of international standards on auditing, already has this requirement which got effective from last year, and that basically is applicable from last year, and then people have started to do this scoping for group audits already. Yeah, so in moving on, so this is one example of so the same list of companies. There is a parent, there is entity B, A, C, and D. So these are the ones in one in grey is a joint venture, and the ones colored in blue is associate companies, right? So, and this is the total profits and revenue of the entire group. So which are the companies do you think I will need to audit? So just to quickly explain this slide. So parent company is I am the auditor of the parent company. I sign on the standalone and the consolidated financial statements of the parent company. Right, and the parent company has a turnover of 2,500 crores, and the last line, which is 10,500 crores, is the consolidated revenue. And in case of total assets, it's 26,500, and net assets is 16,540, and PBT is 3,100 from a consolidated perspective. And the percentage of total assets, revenue, and PBT is given to the right, and net assets is also given to the right. So parent company I would already be doing. Right, so I will do the audit, I will do the reporting. So so coming to the next subsidiary, entity A. So will I need to do a audit of entity A? Why is that? Yeah, 80% I need to cover. Okay. So okay, coming to revenue, right? So entity A, everyone agrees that it has to be audited. Okay, and any other entity which I will need to audit? Yeah, 48% of PBT. Okay. Entity C. Why entity C? Okay, in Caro it needs to be given. Any other answers? Okay, I'll do either C, I'll do audit of R or else, right? Or it's not required. R is must. Okay, entity C, do I need to do it? Why? Net assets is 36%. Okay. Okay, how many of you are saying entity A needs to be audited? Show of hands. So all others are saying entity A need not be audited. Okay, and yeah, so the current guidance, current SA 600, what it basically says is it doesn't give a threshold. It only says the other auditors can do it, and for you to get a understanding and for you to get a comfort on the entire numbers, you send instructions and you do a sign off on all the numbers. All right, and additionally, in case of listed companies, there is a 80% threshold, and that 80% is basically the total coverage so I am doing a particular company, and I'll need to review the work papers of all the companies covering 80%, because I'll have to take responsibility for 80% of the total of the companies. Right, so I'm keeping that in mind, or else let's come from below. So entity Q, do I need to audit that company? No. Why is that? Yeah, so let's go line item by line item. So first is on revenue. So revenue, I need a 80% cover. So if it is if it's not a listed company, the current guidance is that I will audit the parent. I can send instructions to the other company, but then I need to focus on reviewing all the other work papers, but there is no threshold given. But generally, considering only 24% is covered by me, what I will do is the general scenario which is considered by all the other larger firms are that 70% needs to get covered when you are doing a consolidated financial statement when it comes to revenue. So the first two coverage will give you 70%. So and if it is a listed company, additionally you will also test another 10%, either entity C or entity R. Alright, so and what is total assets? So having the same analogy in mind, when we come to total assets, alright, so entity C, do I need to audit? CC. Okay, C is not required, and C or R. Okay, and entity A, will I need to audit? Yeah. Yeah, A is already covered. So I will do an audit of A. So I will automatically be covering the total assets of A as well. Right. So that gives me a 60 and 70%, 71% coverage. Right. The 71% is not a set threshold, but that is the general threshold which has been considered by other larger firms. And if you are going to do a listed company, yeah, either C or R. Yeah, listed company, either C or R. I need not do an audit. What I'll do is I'll send instructions. I will review the work papers of my subsidiary component auditors. And this is, for instance, for a listed company where there is a requirement that 80% needs to be reviewed by me. And next, when you come to PBT, so what will I do? A and R. Right, so for a 70% coverage, I will need to cover A and R. And R, while it is only it can be a, so in the previous scenario, it is a subsidiary of a subsidiary, right? Still, it earns so much of profits, which could be, which is material for me. So I will do a coverage for R as well. So net assets, so which quantity, which I will cover? A and C, right? So A, C and R you are already covering. Yeah. So everyone agrees? I'm asking. What's your answer? So your answer is no. Okay. How many else is saying no? So how many are saying C needs to be covered? Without C, your C, yeah. C needs to be covered. Yeah. So when it comes to net assets, sorry. If entity R is covered, it will do. As you had initially said, net assets is not a threshold which is defined as per, which is required as per the SEBI guidelines or as per ISA. So net assets, we need not look at it. So I need not scope in just for the purpose of doing a net assets testing. Right? Net assets is basically a net worth, but that is not the criteria. But however, if there is one-off transaction, let's say there's a ESOP transaction which is very significant to the group, which has happened at a subsidiary, obviously you will need to cover. So this is the overall guidelines which is there currently. So 70% coverage is what firms tend to do. And additionally, 80% coverage of review of work papers is what is required for listed companies. So this is the current ISA 600 requirement. Sorry, SA 600 requirement. And yeah, so the 80% is required by SEBI, and net assets is not a requirement for the purpose of group audit coverage. And additionally, what the standards are, the proposed revision of standards. So that basically is such that the primary responsibilities, and there are reporting consequences. So what I'll do is I'll have other meta paragraph in my audit report to say that these subsidiaries have been audited by other auditors. So that is the primary reporting consideration which I will have. And going forward, the standard which is going to get notified next year, which is going to be applicable for listed companies and for public interest companies, which is basically the threshold of 1,000 crores of revenue, 500 crores of borrowings or net worth. So that would basically be what that basically says is that the primary auditor will be responsible for everything. If you are going to scope out something, that is at your own risk. So you cannot come back tomorrow and then say that I didn't scope this in, So it is not my problem. So from a ISA 600 perspective, so you do your scoping in such a way that you cover everything. So that is the 600 revision which is going to happen. That is not yet notified, but the exposure draft has been given by NFRA, and which is expected to get notified from next year, and it will be applicable for public interest entities and the other entities. Right. So and these are the illustrative procedures which we'll carry out: risk assessment and obtaining deliverables, sending out instructions, having a review, and finally reporting considerations if there are any, probably the other matter paragraph which we spoke about, right? So that you will do. And this is the upcoming change which we spoke, the 600, once that 600 gets effective, this is the criteria for public interest entities, which is more than 500 crores of paid up capital loans and the turnover of 1000 crores. And moving on, yeah, there are a few case studies. So one is, let's say I am the principal auditor and another auditor, another auditor has said that receivables have increased significantly, right? So as a raising doubts about recoverability, so what will you do as a group auditor? So I audit a holding company, subsidiary companies, let's say receivable is 200 crores, it has increased by, 200 crores, it has increased to 205 crores. We'll check what is the percentage for the previous year. Okay. Yeah, so basically we will discuss the matter with them, and then we'll see what is the procedure which they have done. They see it as a concern. At a console perspective, I'll again see probably his subsidiary is only 100 crores of revenue. My company and be some earning 5,000 crores of revenue, but my company, from my perspective, it might not even be material. So you do a risk assessment and evaluation of misstatement at your whole core level, and then try and see whether any adjustment is required for this. Right. So, and next question is on a company which has another subsidiary which is audited by another audit firm. Let's say ABC, I am ABC, and DEF is another auditor. And I find that inventory valuation and revenue recognition have not been properly verified. I look at my subsidiary's work paper and I see that he has not done work properly. So what will I do? What additional procedures is in, what will I do? I will go and verify. Okay. So I will further ask them to do it once again. So how many are saying I will ask them to do? I will directly do. I'll say whatever I have time, I'll do. Okay, so they'll only ask me questions, so I will have to do it. I'll qualify. Will the client agree you are not doing work and then you are qualifying the client's books? So it's not a case where client has information. So your auditor, your competent auditor has not done work, right? So you are signing on the console financials and it's material. So who will do? I'll do, he'll do. Someone has to do, right? Yeah, so the answer is someone has to do. So I'll ask him to do it, and if it is not done, so the responsibility doesn't go off from me. I am the principal auditor. I am signing on the balance sheet. So probably you can raise it with the management saying this is a requirement. I am doing all these additional procedures, but from a perspective of this thing, so I will need to do this thing. And if there is an issue with the client and then it's a problem, then I will qualify the report. Right, and this is the last question. So there are two, the subsidiary auditor has given a qualification of inventory balance, and the subsidiary auditor has given an emphasis of matter on the litigations. Right, the litigation comes to 25% of the total assets of the company, and the other one is on inventory balances comes to 3%. Inventory balance itself comes to 3%. Right, so that qualification will I carry over in my audit of consolidated financial statements? I will. Why? It's subject to materiality. Yeah, and the litigation. Yeah. So in the consolidated financial statement, from financial statement perspective, both will get consolidated. So that is not the problem. So, but when it comes to an audit report, again, looking at materiality considerations, if it's very immaterial to my group and the inventory provision is not very significant, I will not do a provisioning at the holding level, and that might not affect my opinion. But this contingent liability, again, thus being a 25% of my total assets will be material. I will need to see whether emphasis needs to be given, and I'll see again, probably I will also need to do additional procedures whether only an emphasis is whether only a contingent liability is sufficient, or should they record a provision, right? So yeah, because you are finally signing on that company, if you are coming to know that 25% there is a particular item which is very material to my group, I will do procedures to see whether provision has to be recorded or not. So that is for scoping in, right? So let's say I have scoped in a particular company, total, this is only total assets. So okay, 25% of net assets. Yeah, so let's say it's okay. Let's not say 25%. Okay, so that was probably an error, but then I'll not. So I've already scoped in an entity, right? And that's the reason why I'm going and checking this balance sheet, because it's already material. So from a scoping perspective, the percentage is already exceeded. So from a contingent liability, I'll do an independent assessment from my materiality perspective, whether it is material or not. And if I see that it is material, I will definitely go and review the work papers and then try and give a. I'll evaluate the from my audit standpoint whether there is any implication or not. So that is more on this standard. So any other questions? Open to questions, and then we will we'll break for tea, and then there will be the next session. So any questions? Yeah, thank you all. Thanks a lot.
So Jyothinadh, based out of Chennai with over 11 years of experience, he has led and managed audits of several medium and large entities which are into automobile, manufacturing, consumer, service and oil and gas. He also worked on engagements relating to Ind AS conversion, foreign reporting under IFRS. For this short profile, I would like to welcome today's speaker, CA Jyothinadh. I also, on behalf of SIRC, also thank the speaker for accepting our invitation. As a token of respect, I call CA Bonastri to present the memento to the speaker. Over to the speaker.
Good afternoon, everyone. Am I audible? Yeah. So now we are going to take up about the risk assessment. So before going to the topic, I just want to understand why is this topic is relevant. Why do I need to identify the risks? Okay. Any other answers from any of the members? So do I need to do this assessment, or I can straightly go ahead and do the audit? Any views from any members? To determine the sample size, okay. Okay, whether the management has appropriate controls to counter the risk. So what is our approach for audit? Okay. So basically the approach for audit, what we are following is risk-based approach. So when we say risk-based approach, it is very critical to understand how the risk has to be identified in an entity. So that is the reason we need to understand how I need to identify and assess those risk of material misstatements, so that I can follow my procedures. So now we know why we are not going to understand the standard. So how do we identify and assess this risk of material misstatements? So I will directly go ahead and then sit with the finance person and close it. I understand process, or is there any process? Normally how we are all doing as part of our practices. So how we are all doing this identification and assessment of risk of material misstatements? Okay. So we'll understand internal controls are there, are appropriate if it is there. Okay. Is there any other ways? You may be doing it several ways. So you can tell us what is the practical ways you are doing so that we can see how it is embedded in the standard. Okay. Okay. So they have a Maka Chakra process or there are not. Okay. Okay. So understanding the entity and business. Hmm.
How will I be able to know? Because majorly everything for a company relies only on two things: the P&L and the balance sheet.
Okay.
Unless I am not able to understand how the sales and purchases is recorded, I won't be able to determine start from that.
Okay.
Operational laws and regulations.
Okay. So he mentioned I need to understand the business and the processes of the business. Sir mentioned I need to understand the laws in which the company is operating. Is there any ways which we are normally doing risk assessment? Okay. So to understand the key management personnel of the engagement entity, whether their integrity is okay or not okay, how it impacts the business. Okay. And this risk assessment we will do only at start of the audit, or we will do during the audit, or we will only do at the end of the audit. Okay. So you are all saying that it is iterative process. I need to do it over the course of the audit. Okay. So now moving on to, as you all members said, yes, we need to understand not only the account elements, we also need to understand some of the entities, and also need to understand the environment which operates, also need to understand the management. So now how will I understand the entity? So if you see as part of the audit process, so normally the risk assessment starts at the engagement acceptance level. That means when I am getting a new client, I will also assess who are the directors and what is the business which is operating into. Then I will also do the assessment at respective processes. That means what is the critical areas like revenue or inventory or sales or purchases, and what is their IT environment. So what are the systems which they are using it, what are the applications they are using it, and what is the internal control. So it's, as you all mentioned, that it is iterative process, we need to do it over the period of the audit. So now what exactly we will cover in entity level risk assessment? What is meant by entity level risk assessment? So we touched about here entity level risk assessment, process level risk assessment, and the account level risk assessment. So what normally we need to do at the entity level risk assessment, or what normally we need, you all think that we need to do? Okay. Any other things? So it applies to overall entity. So axis, sir mentioned. Any other things? So normally, now suppose we take a situation wherein now this US impact has come in terms of the tariffs. So do we need to assess that risk as part of our audit or no? Okay. So that will come under where? It is comes under entity level or it comes under process level? So basically, if we see what normally comes under entity level as per the standard, some of the examples are industry and external factors which is impacting the business. So that is one we spoke into the US tariffs. That is a new regulation has come into picture. which affects my industry, or any new competitor enter into the market. So for example, I am into an sales of leggings. So there is one more new competitor come and put a shop next to me with this lower price. Like we have also seen Reliance come with Judio, and also other parties come with different brands, which is lower than the price at which I am giving. So it also comes into what the competitor has come into picture. It also covers the technology which I am using. So any new technology has been brought into another person, which impacts my entity in which I am operating the business. And also the seasonal nature of the business. So whether the season at which I am doing it has any impact in terms of the rainfall or in terms of the other macro environment factors. These are all we need to understand as part of industry and external changes. So normally we will discuss these items with whom? So yes, so it's not necessary always you need to discuss only with the account person or CFO who is our juniors are dealing into. So we also need to understand these items from the respective heads. That means the key manager person, as he mentioned, in terms of technical changes, we also need to understand the sales departments and purchase departments to actually understand how each of the items will impact my entity. So is there any other items will comes under entity level factors? The other one may be internal environment. So what do we meant by internal environment? So one of the factors in entity level is internal environment. So what do we meant by internal environment? Okay.
Non-rotation of a single employee among other departments.
Okay.
There is also a risk because she will be moving in and out of the business. So there is a possibility that he might.
Okay. So it includes the key manager staff who is dealing my businesses. What else will come? Internal. So it's just basically the policies. So if we see, these are all the items which will affect the environment. Suppose the company is entering into a new market. So which the top management thinks that now there will be a demand is there for XYZ product. So which I want to enter into it. So that market is a new risk which is opening it for the entity because they are entering into a new market, or they are entering a new location where already there is a competitor is there. So that is one of the factors which you need to assess as part of internal environment. And again, as I mentioned, the changes in the internal management and also the control environment. Whether any company has any control process which is there as part of their existing environment which deals with how each transaction is processed. Yeah.
Just wanted to know, like how Jio came into the market. Like suppose you are the auditor of Airtel, then what that comes into from center first part, industry and external.
Yes.
Or say now Reliance is coming under independent water. They have come into water. Now if you are an auditor of business, then what will you do? You have come, that doesn't mean that it will affect. What do you see?
Yeah, so basically that is what we need to understand exactly what Jio come into the which product. So no, we need to see in water. Yeah, so TV they come into, and also they came into the online streaming. So if my business is also to give this online subscription basis, I need to assess as part of my risk assessment how the streaming business what they come into will affect my customer who am I seeing, whether any footfall in the customers which I have seen because of this, and how their prices.
That is been taken care with the sales team and the respective price. What auditors will do in that? See, that is
Yeah.
the case in Vodafone India is using their customer base, because of which can the auditor give a can change his audit opinion? No,
No, it's not about.
The accounts of the company, right?
Yes. So suppose last year there is no competitor is there. So you may have taken the risk of sales is lower because you are the only person in the industry and you are the only person who is doing this business. Now when the auditor, new person come into the business, you need to assess whether how it impacts my projections which I have given for last time, any going assessment you have done, any impairment you have done, or any loans you have got from the external parties saying that my business will give me a profit of 200 crores a period of 5 years. Now all those things will change and it leads to your other risks where I may breach the covenants because I didn't reach the revenue which I am going to enter in because of the new competition. So basically you need to assess, okay, new person came, but his stream of business is different from my stream which I am doing. So no impact.
Now, how will you assess the impact?
So you need to have discussions with your respective persons in the management who is dealing with this business and how they are foreseeing this impact. So
They will also not be knowing that how Jio is coming to the market and how it has disrupted the entire telecom sector, right?
no, but they may know some information.
Airtel was there, when Airtel was there, did they come to know that their market share will fall down below 50% and come up to say 30%, 40%? Not possible. Vodafone India, all other then how did they assess in that particular financial year? That is what I just wanted to know.
Yeah, so it's not that it is a single process. Today I will assess it, I won't do it in the next month or the next over a period of 2 years. So, but there is an action has been started. That means there is an competitor newly come into picture. So with the information what they have presently, they may know more than us saying that, okay, Jio has come into the picture. So we are also getting data. Presently, I have also seen my trend decreasing in my subscription. That is one criteria which they observed. And they also will see, okay, it's not that they won't have informal people who can explain what is the business they are into. So they will also get understanding saying that, okay, my streaming rate is 200, they are giving it only at 180. So this is one risk factor which is increasing my business. And second risk factor, it's already seen in my subscription reduction. So third factor, so on a monthly basis, they also need to understand what impact is slowly giving. So as an auditor, you also need to keep it as part of your risk profile. Okay, I have discussed this current month. This is the only situation they have based on the data. As of now, there is no major impact. But at the come after 2-3 months, again I will go and inquire with him. So what additionally have you observed? And there are also news articles will come into picture. How this revenue is booming or what the Reliance is going to do in their con calls. So through which they also get additional information. So you need to assess and keep it as a limelight in your discussion process. Saying that yes, this is a new news came into picture. I am also aware. I am also inquired with the management. Management also may have put special team to address this issue. So that is what we are telling. You also need to consider this as one of your risk factor which impacts your business.
Specify in the annual report.
No, see, whatever we are discussing here does not require to be specified as part of your audit report or annual report.
In case of Airtel, when Jio came, that was one of the significant shock to Airtel, right? So did they mention in did the auditors mention in the report?
No, it's not. See,
They should have mentioned if that is the case, because that is one of the key
One.
factors which is to be addressed by the company as
So-
a whole for the company.
no, you will.
So this is basically a risk assessment, right? So this is not a
Audit
audit
report.
opinion per se which you are going to give, as Jyoti had mentioned. So risk assessment is something which you do before your audit process. You basically go to the management and see what are the internal factors which I have, what are the external factors which I have, which might affect the business in future. Right? It need not be a case. So let's say my revenue has dropped down by 50% because of a particular competitor who has come into the market. I will not go and qualify my accounts. Right? So what I'll do is, so there is a going concern assessment which is underlies the presentation which the company has done, and there are multiple impairment related consequences, and there are related party related consequences. There are so what I'll do is what I'm trying to do here is I'll see what are the internal aspects. So let me give an example. Let's say I have a export customer which amounts to 80% of my entire sales, and I have only one customer. So now that export customer in the current year, when I discuss with the management, and let's say from 80% it has come down to 70%, and like when I go and ask them, they say there is a new guy who has come in from February, and that because of that guy my revenue has dropped down. Right? So there is a risk that in the next 1 year my revenue will go drop down to zero, and if that is the case with the assets which I have purchased for that particular division, so that will be idle. Right? So risk assessment is not the final conclusion. Risk assessment is basically a initial input for you to do multiple other procedures and then reach to a conclusion. So you do a risk assessment and probably then arrive at a certain, so there will be certain pointers which will come to you, right? So I need to focus on this, I need to focus on this. So those list of items you will keep note down and then you will try to do further procedures on that. So I don't say today Jio has come, Airtel's revenue has dipped down. Even if Airtel's revenue has come down and still they are able to manage the business, there is no, from an impairment perspective, there is no problem, and all the assets are intact, then I don't have a problem. Right? So that's
So basically to your question, suppose once you've seen this problem, if suppose you've done your risk assessment at the November, but by the time of March, you have seen drastic decrease of your revenue. And now it will trigger your other risks like in terms of going concern assessment and impairment. Then if you assess it that yes, based on the projections now, it will trigger a going concern impact, then accordingly you need to report in your audit report, and the company also will report in the board of directors report, stating that yes, because of this new customer, my going concern is got into an impact, but I have proper inflow will come from a promoters who can put in cash, so that I am giving either going concern appropriate or I am saying going concern not appropriate. So, but as part of risk assessment, you need to consider these events and you need to monitor it as part of your audit on a regular basis and accordingly improve your audit procedures. So that is the reason we are telling one of the risk factors which you need to consider as part of understanding entity is the need changes in the business and new changes in the top management. So the other one is the organizational governance and finance structure. So this basically what will come under this? Suppose a new promoter which has come into your company who has invested some amount. So he may come into the company with some projections what the management has given. So there will be a pressure on the management to give the numbers if not met as per the projections given to the that new investor. Or there is a company in which already promoter is there, but now he excluded from the company. So normally when a new promoter comes, they may insist on many controls and processes as per their view. But we need to understand whether because of this promoter is exited, is there any change in my controls? Because always if you see there is difference between the extent of controls which is there in the promoter driven company and then non-promoter driven company. So you need to consider this as a trigger event for you and then assess accordingly whether any of my risk assessment done last year which will impact in the current year. Why basically is if it changes any of your risk perception, accordingly your procedures for each of this risk has to be increased and the sampling as discussed in the morning will increase and accordingly we need to do our procedures. That is the reason you need to look into these aspects and consider as part of your entity risk assessment. The last item is on the regulatory and performance measure. So we all know the current regulatory environment has brought into some ESG. So where you need to look into make net zero for 2040 or 2030, the timing is changing on, but somehow it will come in a future period. And they also implemented some disclosures which each company has to do. So it is a new regulatory change which will impact the company. So whether we need to see whether the company has adequate cash to meet these obligations of new emission zero or whether my company will be in existence if this come into actual law. So those are the assessment which you need to do as part of the understanding entity environment. So can we move on to other factor? So apart from understanding environment, we also need to understand the internal control. So what normally comes in understanding the internal control? The company has just has an RCM. Is it sufficient? I have understanding of full internal control. So what normally I need to understand as part of understand the internal control? Okay. Okay, there is a framework which needs to be there and policies should be there. Yeah. So somebody is there to monitor this framework, whether it is followed or not followed. Anything else? Yeah. So it will cover only business risk or only operational risk.
All tax are under control.
So it's,
They have been already delegated that quite well.
so you also need to give an opinion, right? Are you relying on their opinions? As part of my audit, I also need to give control's opinion. So if I need to give control's opinion, first I need to understand what controls the management has. And
Can you directly inquire with the internal auditor? Or do we have to again the management?
so presently, if you see, our SAS won't allow to rely on the work of the internal auditor or any other auditor.
One CA does not rely on another CA.
No,
We need not, this is not recorded, right?
it's presently not allowed. So if not allowed, then you need to perform your own procedures, and again you need to understand your own internal control environment, because you are also certifying, saying that yes, the controls are there. So when somebody has come and asked you, they won't ask the internal, because I relied on the internal auditor, so you please go and check with him. They'll say you also certified, saying that yes, it is available. So that is the reason we also need to understand the internal control environment. So as part of internal control environment, we need to understand, as we discuss control environment, basically from the top down approach, we need to see who is actually overseeing this internal control has been implemented properly or not, and whether they have adequately, the internal control environment has adequate controls not only related to business, it also has financial related controls. And accordingly, we need to see the risk assessment process. So whether the company also has a process wherein they identify the risk which is impacting their business. So it's not that the auditor will come one day and identify these are the risks for your entity, I will do my own procedures. They also need to have the business risk and the entity risk assessment and identify appropriate controls which address those risks. Then auditor will go and test those risks and procedures whether they are appropriately working or not. And monitoring of controls. So basically, if just because I have one framework but nobody is testing, is it sufficient? So I have a framework, I have RCM, I have internal controls, I have risk assessment, but at the end of the year nobody is testing. So when I say this, the company has adequate internal control environment. Yes. So somebody also has to monitor whether these controls are appropriately working, or if any actions has been given on those controls, whether those are adequately implemented or not. So that is where, when you are understanding internal controls, because if the company doesn't have any internal control, accordingly my risk assessment will increase and my sampling will increase. When I am testing a sample based on internal control reliance and not testing based on internal control reliance, obviously my sample will vary. That is the reason we need to understand whether the company has adequate internal control environment or not. Then next comes to the account level risk assessment. So what exactly will come in account level risk assessment? So we understand the entity level risk assessment, and then we understand the internal control environment of the entity. Now we need to understand the account level risk assessment, process level. So what exactly we mean to say about process and account level risk factors? Okay. That is control. Yes. Anything else? Yes.
Non-working day transactions.
That will come in the control environment or entry level. But what exactly in the account I will consider? Suppose if I take revenue. So what exactly you want to understand in revenue from the client? Or what exactly you are understanding from the client in revenue?
What type of entities are you?
Okay.
Related party account.
Okay. 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 So basically, as member said, I will understand the composition of the account. I will understand how the company ensures completeness and accuracy of the account, and what is the extent of internal controls which is there in the account. But apart from that, we also need to understand manual entries, as I mentioned. how is the IT elements which is there in the account. Whether my account fully depend on the IT environment or it is depend on manual entries. So what normally comes in the entity account of factors is,
Sir, one doubt, sir.
yeah.
Very silly doubt. Just asking. If you have ever been to DMart or Jio, wherever it is, if you see, in case of packed goods, they scan the barcode. Correct. Now, if it is the same product, say a packet of food, for example. So I am giving her that I want two food packets. What she is doing, the same barcode, she is putting twice and seal it. That is the case, and how will you control? That is in the computer, if you go and filter the same barcode, two has happened. That is practically not possible. Then how is that system allowing? Then how do you think there is a weakness in the internal controls?
Yeah, so that is the exact thing you need to understand from the management and as part of your process. So if this type of lacunas are observed in the process, then accordingly you need to increase your risk assessment for that respective area. Because they may have process where irrespective of the barcode, if I scan 2 times, it will reduce the inventory for 2 times. Or they may say the product is not linked to a specific barcode. It's only identify the nature of the item. So the quantity will automatically decrease as part of your inventory. So if it is mitigates your risk, what you identify, your problem is the material may not have decreased 2 times. But if it is getting decreased 2 times, but the barcode is only to identify the nature of material, not the specific item, accordingly your risk is mitigated. So those are the items you need to understand as part of your process and account level risk factors.
Via barcode level, how much sales has happened, and via actual level, that would be a discrepancy in that particular scenario. That is what you are trying to tell, right?
No, I don't know how the process is there. So if they have the discrepancy or not. So those and all you need to understand as part of your process and account level risk factors.
Probably to add on to exactly what he said. Right? So he said, let's say example of a biscuit. So you have a barcode on each biscuit, right? Once you scan a barcode, it identifies that it is a particular type of biscuit. So the scanning of the barcode is primarily only to facilitate that whatever barcode I scan for the same biscuit, it's going to show the same 10 rupees. Right? So and if I'm going to enter the quantity correctly, and then if I'm going to record a sales transaction, so then at the end my risk is, so what is the risk which I have? So the number of quantity which is there in closing stock is not being right, or the sale value is not being recorded appropriately. So both are taken care of. Only the item which you are not taking care of is, let's say you have a barcode wise register. So one material appears 10 times with different barcodes. So then that listing might not correctly appear because one barcode is clear. But when you are talking about a DMARC kind of a scenario, so no one will maintain 10 line items for a particular biscuit. Right? So it will be at one line item itself saying 10 quantity. So that information which you are saying, so that is not consequential, that is not even relevant for the company. And for that, while it could be a control lab, but it is not even a control according to me, because my risk is not that. My risk is instead of 2 quantities, they put it as 5 quantities. That is my risk. So, but at the end of the day, both are of the same price and of the same nature. That's what he had explained. So then there is no problem for me in that concept.
This happens in the case of low-end items. In a jewelry shop, this will not happen.
Yeah.
Because their individual items will have individual barcode. So it is 2 different items. Here the control is not for the exact match for the quantity.
Why do you have to scan a barcode?
It's for the category. That scanning is for the whole category as a whole.
So if you are scanning a 10 rupees product, and then if you are recording a 50 rupees product, and if the system allows that, that is a control lapse. Right? Because your risk you are trying to identify is basically this finally your value is coming correctly or not. Right?
See, sometimes scanning they may put to achieve the efficiency in the process, but it may not be your control also. So that's where you need to understand your account level process, whether what I am identifying is a control or it's only a process. Because they don't want to enter it each time the biscuit code and all those things. Instead of entering a 5-item biscuit code, they just put the process of scanning. So they itself may not have taken it as a control. You need to understand what is the control they have. Accordingly, you need to pinpoint that control for the risk, what you identified. So that's where you need to understand more in depth in terms of the account level and process level risk factors. So basically in process level risk factors, we will see the quantitative factors. That is, how much is the account. Suppose if I take revenue. So whether is revenue is 100 times of materiality or 50 times of materiality. And whether the entries in revenue is getting posted at the year end or consistent across the same over the month, or it is only coming in respect to months. So those are the items you will cover in the quantitative risk factors. And then process level risk factors. In process level risk factors, you will understand, is there any change in the process, what they are doing in the current year. That means till last year, they are accounting it through an X process, wherein two persons are there to make the entry, one for parking and one for posting. Now current year, they have changed it and make it as single posting. So that will come and change in process and changes in IT environment. So till last year they may do manual process. Now current year they implemented new system in this process to account the revenue. And change in terms of the agreements or judgment during the process. Now current year they have more percentage of completion method process. Last year they have only full completion method process or only sale of products is there. So all these things you need to identify and understand as part of your process level process. Account specific factors is basically the customers, agreements and all those things. So till last year, if you take example of sales, all my sale products are X works basis which I am going to sell. But current year I said all my customers required door delivery. So if I didn't understand this process, my sale cutoff risk I may not have identified. Because last year since it X works, I may have taken my cutoff risk as an low or higher, because I am not identifying last 2 days sales is very immaterial for me. But current year, since I changed my agreement, wherein I have delivered, now I change my terms as door delivery. That means I will only recognize revenue at the time of the good reaches the customer. So that I need to identify the lead time for the sales. I need to see how many days it's coming, whether it's 30 days, 50 days, 60 days based on my location. Accordingly, it will increase my risk of cutoff in the sale. So these are the factors critical to understand each of your risk while you are doing risk assessment, because based on this you will identify whether the risk is higher, lower or significant, and accordingly you plan your procedures, because ultimately what we are doing this for, to identify the procedures what I need to perform to understand whether I am doing sufficient appropriate audit evidence or not. So as we recap, so we need to first see entity level factors, and then we need to see internal control, understanding internal control environment, and then we need to see account specific risk factors. So all these together you can embed as part of a risk assessment, accordingly identify the risks. Are we clear till here? Any clarifications? Now we will see some examples. So assume a company which is actually investing in oil companies. But the news has come stating that the oil prices has fallen 50% from the last year. And there are analyst reports which also says that there will be a decrease in profits for each of the oil companies. And my company is not into manufacturing or selling of any oil, but I'm only investing in oil companies. So will it impact my industry?
Yes, because your investments are material investments are there.
Okay.
Valuation of investments will not be changed. That will not happen. Either you will have to write off that. At the time of write off, there's a point.
Investment value may be recalculated, stating cost of market value, your risk was
Okay. So as you all said, yes, it will impact your risk assessment of investment valuation, because current year there is a scenario wherein the investment you made in oil companies, they have an impact. So accordingly you will change your risk assessment from the for investments, specifically to assessment valuation. Maybe last year you may have taken lower, so current year you may take higher, and accordingly perform the additional procedures which is required. And it is a change in entry level control, entry level risk factor or account level risk factor. So both may come, because it is not directly related to your account which you are doing. It is because of the macro environment factor which your account level is impacting. So it will cover in both.
So, but what if they have taken
Yeah, you can document all those things. See, as I said, this is one of the factor which is impact or risk assessment. But if you have alternative risk procedures the company has already taken, like they may have identified this item before itself, and they may say, okay, I'll also take a H item. So if ultimately your risk assessment is increasing or not, that you need to conclude in your risk assessment work paper. Because see, this is only highlighting that this is risk coming to environmental risk factor in my current year. Yes, I have gone through the risk and I have assessed so and so documentation, and I am fine still with my classification as lower or higher. What I did in the last year. And this is in terms of another case scenario. So a major tropical storm has caused damage to the resort's vacation, in which in a jurisdiction in which our entity is there. While the entity does not operate in tourism industry, but it is a supplier of food and beverages to resorts. And majority of the customers are hotels and resorts. Will it affect my risk assessment? Yes. Because as other case of oil, this also impacts my sales, which I am going to do that industry, as the entire industry has been impacted. And the other example, the entity has a patent related to product that it manufactures. The patent expires in the year under audit, and upon expiration expected to the significant number of competitors will enter. So basically, I have a patent product which is expired, and other competitors may have a chance to enter into this product. It will impact my risk assessment or no? Yes. So these are similar examples. I am skipping it off as it's the same nature, and you are all answering very correctly. So then overall risk assessment, as you all are now discussed, so we need to identify the risk factors and assess the controls the company has, and based on that you will identify your magnitude of risk as higher or lower. If it is higher and material, you will take it as significant risk. If it is lower and have sufficient controls, I will take it as a lower risk. And in this case, we have taken an example of operating expenses, and the risk identified are not in operating expense recorded in incorrect amount, or not recorded in the correct period, and all those things. And these are the factors. In your case, for each of the risk, you feel it as lower or higher or significant. Can you please let us know? So in terms of nature of composition, it says it is more than a materiality. And degree of complex, other expenses, there is no degree of complex, so it's homogeneous transactions. And specialized unusual items, there are no unusual or one-off items. So can I say, considering all these factors, you can take 2 minutes. Considering all these factors, what do you feel with respect to each of these risk items? You will categorize as low or high or significant. So one is operating expenses recorded incorrect amount. Operating expenses recorded that did not occur, that is cut off. Completeness. Operating expenses recorded incorrect period, cut off, incomplete, and not in the proper account classification. So considering these factors, the entity has documented, you feel any risk will come as a higher risk, or all the risks continue to be lower risk? So composition is very extreme material, but there is homogeneous population and no unusual items. And degree of complexity, there are no complexity or no judgments involved in this account. Risk related economic and accounting other developments, no, this is account won't impact any of economic factors. Potential magnitude of misstatements, based on last year assessment, we have not identified any misstatements in the account. So considering all this, do you feel any of the risks in operating expenses will be higher, or it will be continue to be lower? So these are
Blend of everything, and on that basis these 5 parameters, or for each and everything I have to give the risk parameter.
you need to, these are the risks.
Things are there.
Yeah.
The 5 situation I have to blend it, I have to take it as a whole, and then on that basis I have to do the next level, or each individual wise I have to.
So, yeah, each individual level, you will feel risk of your completeness is higher or lower based on the facts which is mentioned in the next slide.
So third and fourth is significant risk. No, second and third is significant risk.
No, presently, the last year they identified everything as low. Okay, all the risk last year they assessed as low. Now current year, these are the facts. Based on these facts, any of the risks which you feel increase the level as low to higher, or it continue to be low. You feel any risk will become higher or it continue to be low? Okay. Okay. Any other views? Yeah, it can become, but if any specific controls is in mitigating those, again they can conclude as a low. So based on the facts, ideally there is no change required, but again it is specific to changes in circumstances of entities you are auditing. So you can assess based on the facts of that. And you can also document what we discussed in the below format, saying that each of the factors, this is how I analyzed it, and according to my conclusion is high or low. And as we all discussed, risk assessment is an iterative process. Even if you did a term of planning, again you need to assess based on the conditions or events which occur after the planning is done. And as summarize, if you see, we need to consider our all external factors, industry or regulatory factors, reports and all those things, and convert into each of the qualitative risk factors, process and account risk factors. Based on this, you can finalize your ROMs as significant ROMs or normal higher ROMs or lower ROMs. Why we are doing all these things is to identify what extent of procedures which I need to finalize for each of my risk identified by me. Clear? In terms of what factors we need to assess as part of risk assessment. So now we have done the risk assessment. So next, what is the step? Sorry, sir?
On that basis, I will take a sample. I suppose that particular area is more risky, higher sample I will take.
Okay.
And the few areas where it is low risk, I would rather do a random sampling and try to get that particular I might segregate into on the basis of volume, all those things, and I'll try to do more sampling in order to satisfy myself that there is the controls are.
Is there any step will be there before sample? Yeah, we are doing all this in planning only. Okay, evaluation of? Yeah, we have done the risk assessment now. So we identified, suppose in revenue, 2 higher risk and 3 lower risk. So what is the next step?
We have to determine the levels now, like materiality for each and every risk.
Yeah, that's what we.
If it is higher risk, then I keep the materiality level as very low for that, so that I could see more samples.
No, samples will change on the level of the risk. That is maybe higher risk, lower risk or significant risk.
Samples, okay, I agree, but for that also you will have to filter the amount, no? That amount you will determine first, no? Then only you go for the samples, right?
That is population, you are telling. Okay, but before that, I need to identify the procedures, right? What procedure which I am going to perform. Yeah, so you need to plan your procedures. So once we identify the risks, we need to plan our procedures to address these risks what we identified. So the next standard is on addressed the risk of material misstatements. So basically, it talks about the procedures you need to plan. While doing that planning, what exactly we need to consider. So procedures is any way which we need to consider, any process which is defined standards. This is a process I can consider. Like, do I need to consider procedures on my way, or I need to consider some planning procedures or interim procedures, or substantive I need to use, or controls I need to use? Or I feel this is a procedure I need to do, I can continue it and go, move forward. So how do you all plan your procedures? Yeah, so you will rely only on substantive procedures, or you will rely on control procedures, or you will plan both. So this where the standard says we need to first determine the nature, timing and extent of procedures. So what will come in nature? So now I identify my risks. So when I am doing my procedures planning, so I need to see the nature, timing and extent of procedures. So what is the meaning of nature in your view? Nature means nature of procedure. So what will comes in nature means whether I will do inquiry procedure, or I will do inspection procedure, or I will do observation, or reperformance, or recalculation, or analytical procedure. So when you are planning your procedures, please keep in mind the nature of procedure which you want to perform. That again depends on coming back to what is the area for which I am addressing the risk, and what is the assertion which I am addressing it. And in terms of the timing, so what do you think the timing means? Okay. During the audit period, you will the timing normally means whether it is I will do at interim level, or I will do at the year end. So you also need to see whether all your procedures you are intended to do at the interim stage, or you are bifurcating your procedures. Okay, 3 procedures I will do at interim, and 3 procedures I will do at year end. So you also need to decide on the timing of the procedures. That again depends on the area which you are planning these procedures, because it's not possible for all items to do the procedure at interim period. Sometimes you need to do only at year end period. So that is where you need to decide whether the timing of the procedures will be interim or perpetual I will do, or I will do only at year end. Then the extent of procedures. So extent of procedures mean what? Which one? Interim. Okay. Suppose if you take the inventory, physical verification. So you may plan to do at interim also, or you may plan to do at year end also. But if the standard what it says is, if you have done the interim procedures, again you need to understand the composition of the account balance and the movement happened during from the interim to year end. Suppose as an entity I have decided that 31st December 2024 I will do the inventory verification. And year end I am not planning to do any procedure, because based on my understanding of the entity, after December the movement is only very immaterial for me. So I will just do the roll forward procedures for the balance period. Again I won't do the inventory verification fully. Same thing applies to confirmations also. So some companies, based on the year end deadline, they may send the confirmation procedure at interim, and they won't do the year end procedures, but they will do the roll forward procedures from December to again year end. So if you decided your procedures at interim, then accordingly you need to also plan your procedures, what extent of the roll forward procedures which I have to perform. So each of the timing what you decided will depend on again the extent of procedures you need to do at year end. And even though in control testing, sometimes the company wants to do interim control testing, the auditor wants to do interim control testing, because if any deficiencies they identified at interim, they want to appropriately mitigate it before year end, because the control reporting is as on year end, not for the entire period. So if the company is able to mitigate the deficiency which identified in the interim period, then myself for opinion, I can give a clean opinion, even though if it is a major material weakness identified at interim period. So that is the reason you need to plan whether you want to do interim. If so, you want to plan for interim, what procedures you are going to do at year end. Suppose in the same example, I have did controls at interim, but there is a change happened in the entire system implementation from one software to another software. So do I need to, can I rely on entire interim procedures, or do I need to do afresh again at year end? Any other views? So you need to do afresh, because what is the process, what you understood, the controls is depend on the earlier process. That process is not existed as at year end. So again I need to change my timing of the procedure to year end, and I need to test the 3 months period. Clear in terms of the timing of procedure? And extent of procedure again depend on the controls and the sample size. So now here it comes your point of sample. So whether I will do higher sample or I will do minimum sample, what is required. That again depends on the control which I have tested. Suppose the control is operating on a monthly basis and I didn't identify any problem in terms of the control what I identified, then I can reduce the samples to minimum sample. Suppose what the control I identify for the risk has some ineffective control in that. Accordingly, I need to change my extent of the sample procedure which I have to perform. So we need to, when you are addressing the risk of material misstatement through a planned procedure, please keep in mind whether the nature, timing of extent of procedures has been factored in. And can I use last year testing for controls in the current year? So there is no material change means?
Like the revenue, or like how they used to record the revenue, all those things, status code, we need not again have to recheck it. We need not again have to redefine the control or the procedures what we can.
Okay, any other views? Okay. Any other views? So we can rely on the last year controls if ICFR opinion is not applicable for that entity, because for ICFR I need to confirm every year that it has been there as part of the year end. So if the entity is not covered in ICFR reporting, yes, we can continue use last year evidence, subject to whether there is no change in the process, there is no change in the environment, there is no change in the business which they are operating into. Suppose if the change in business is happened, again need to identify specific controls for the change in business and do it. So can I use this same strategy for significant risks? So for significant risk, we don't need to, we need to do testing on a yearly basis. We should not rely on the last year testing done for the significant risk. Because for significant risk, the risk factor is assessed as high, very high and significant. We need to test controls each year. So these are the items which we need to consider while factoring the planned response to risk of material misstatements. So now comes to the analytical procedures. So this is what we discussed, nature, timing and extent of procedures. Again, your procedures, please make sure that only substantive analytical procedures won't suffice the substantive procedures, and only inquiry procedures won't suffice the procedures what we are planning for it. So it should be a combination of both substantive and control procedures, or substantive analytical and substantive procedures. It can't be a single item. Now in terms of analytical procedures, so what are the analytical procedures do you think in your you are applying as of now? So any analytical procedures you people are using? So what are the general analytical procedures we do as part of our audit?
Use of ratios.
Okay. Okay. Any other analytical process we will be doing? Between two different account balances. Okay. Any other correlation you people done? So preliminary analytical procedures, will it consider as analytical procedure? Okay, preliminary analytical procedure, we will do the variance at the starting of the audit. So will it be analytical procedure? Yeah. So it will be analytical procedures, but it not be an substantive analytical procedure. So we need to understand analytical procedure. There are two things. In substantive procedures, we will also use substantive analytical procedures, and there are analytical procedures. So substantive analytical procedure means we need to understand the correlation between the two amounts, and we are able to independently create an expectation. Where in normal variance analysis, we are only comparing two periods and understand what is the reason for increase or decrease. So while you are doing substantive analytical procedures, is there any things we need to keep in mind? Like we need to see how the data is coming, or what are the things we need to keep in mind? So basically we need to see whether the analytical procedure is suitable for the account balance which I am doing it. And the reliability of the data. Suppose if I am doing analysis on sales with the cost of sales. So I put a correlation wherein there is no fluctuation has been happened. But when I understood the sales data, it is manipulated. So when you are doing a substantive procedures, you need to understand the source from which the data has been received by you and from which the company also extracted. Because any change in that source data will impact your substantive analytical procedures. Clear? And develop expectation. So I need to first understand with the analytical procedure I am going to select. Can I do payroll to revenue as an analytical procedure? So again depends on the industry. So if you are doing a cost plus industry, so you are able to do expectation between payroll and the revenue which you earn. So that's where when you are developing expectation, you need to see whether it is relevant to my industry and whether I can able to actually create analytical procedure or not. And how do you close the difference? Suppose if any difference comes. So I have got an analysis done substantive procedure. I got a difference of 10 crores. But my materiality is 8 crores. So in this case, can I say substantive I performed its only 10 crores difference? Can I move forward? So my materiality is 8 crores. Yeah, any other views? So as sir mentioned, once you got a difference, even not if whether it's exceeding materiality or not exceeding materiality, you need to first understand the root cause of the expectation difference. Like for example, a simple payroll analytical procedure. So I know the number of employees increased only 20 people, and I know the increment given during the current year is 10%. So what I've done is I've taken the last year's salary and then put this extra people and 10% increment. But I am getting a difference of 20 crores with the actual salary they booked it. But my materiality is 40 crores. So even though it is below my materiality, but considering the assumption I used, there should not be any difference, should not come to this extent. So when any difference has come in analytical procedures, please inquire or discuss with the management in terms of what is the reason. Accordingly, you can change your assumptions and then see whether you are also reaching the same point. Whether can I do substantive analytical procedure alone for any risk for any risks? I did for payroll only the substantive analytical procedures. I have not done any test of details. I have not done any control testing. I said my risk is mitigated because My substandard procedure only given as 2 lakhs difference. The overall 2 lakhs difference. Yeah. So as you all said, alone substantive procedure alone won't be sufficient. You need to either link it with control procedures or substantive procedures to see the underlying. Again, why you are doing substantive testing? Because you need to underlying evidence. The pay sheet what you have taken should be reliable. So how can you do reliable test of this payroll listing? I can test with the offer letters and all those things. Once I got comfort on the listing, yes, I can rely on again substantive procedures. Yeah. So some of the analytical procedures which we can use as part of audits are depreciation analysis. So this every company may be doing it, every audit we may doing it. We will recompute depreciation based on useful life and compare with the management. And we can also do month-on-month analysis of payroll with the head count. So the average salary per month. So any difference, normally we can inquire and say any increments given or bonus given in this particular month, because of which it is getting deviated from the previous month. And expectation of payroll expense, that is we discussed as last year's salary and increment percentage. And revenue month-on-month, location-wise, product-wise. Because sometimes revenue, if you do month-on-month procedures, you won't be seeing any anomalies. But when you do the location-wise analysis, you may observe that one location there is a huge loss or decrease in customer base, another location there is increase in customer base. So there you can inquire, is any specific reason this location has decreased, or they have just all the customers gone from there, or they just increase it through a separate entry in some other location. So that revenue you can do that. The other thing what we will do in manufacturing is revenue versus cost of consumption. So this is one thing you can also check it as analytical procedure, because it also gives your gross margin changes on a month-on-month basis. If it indirectly gives you an assessment saying that inventory valuation somewhere it is not getting correlated. And addition to employees to addition to computers. So if you take a cost plus entity, so one of the analysis which you can do is the number of editions. Normally in software company, employees work on laptops or systems. So you can correlate it with your laptops what they added and the systems what they added. So it will give an indication saying that there is no bogus employees or there is no employees just get created on the books. Yeah, so we are asking only the count of the employees.
But what if the old laptop is provided?
No, old laptops won't be there in your affair. No. See, one more thing what we can do is you can ask the employee related key which they are using.
The thing is, depreciation for computers every happened in 3 years.
Yeah.
Do you think that laptops have been depreciated in 3 years?
No, it's not about depreciation. You can see the count in FAR. Number of laptops count in FAR, number of employees in your employee organization. So it will also give us an indication saying that I have only 100 laptops, but I have 500 people. So where the balance people are working on. So I'm not saying it's a pull-through procedure. It's only an indication saying that through which you can identify other risks which we are not identified through normal procedures. And manual entries posted on a month-on-month basis. Suppose as per your understanding, you have got to understand saying that normal procedures, normal entries they pass is only accruals of expenses, which is hardly some 10 crores or 5 crores. But if you all see the month-on-month analysis, you are observing that 20 crores, 30 crores has been posted as a manual entries. So which gives an indication saying that something is not going as per the process. And other items are rent expenses analysis, interest expense analysis, which we will normally recompute and then check with the company's balances. So these are some of the substantive procedures which you can use as part of your audits. I think these are the examples. So in this case, the auditor identified that the rent expense decreased by 10%, but there are no new locations or elimination of existing locations. So he has recomputed the rental expense or income and compared with it accordingly, made an adjustment to the financial statements. Same way they have computed the sales commission based on recomputation of the sales they have incurred in the current year and the percentage as per agreement, and they have observed that there is no differentiation observed from the last years. Accordingly, the risk has been continued to be. So there are same cases, there are no major items. Any questions? So I hope now you are clear on how or what factors you need to consider as part of risk assessment, and how many stages of risk assessment is there, and how do we plan the procedures for each of the risks, and how we can incorporate our analytical procedure as part of our risk assessment. Okay, thank you.
Thank you, sir. Thank you, sir.